Good morning, everyone. I declare open this hearing of the Senate Select Committee on the impact of climate risk on insurance premiums and availability for its inquiry into the impact of climate risk on insurance. I begin by acknowledging the Wurundjeri people of the Kulin Nation, the sovereign owners of this land, and pay my respects to elders, both past and present, and I extend that respect to Aboriginal and Torres Strait Islanders people here today. We will be conducting today's hearing in person and via teleconference. I'm joined by Deputy Chair Senator Sheldon and committee members Senator Sharma and Senator McLaughlin. These are public proceedings being audio streamed live with open captions via the Parliament's website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. The Senate has resolved that an officer of a department of the Commonwealth or of a state shall not be asked to give opinions on matters of policy, and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not preclude questions asking for explanations of policies or factual questions about when and how policies were adopted. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer, having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind committee members and witnesses who are appearing via teleconference and who are not speaking to mute their microphones, please. Could I also please remind those contributing that you cannot divulge confidential, personal, or identifying information when you speak. If you wish to supplement your evidence with written information, please forward it to the Secretariat after this hearing. And I do ask everyone to ensure that they have switched off or turned their mobile phones to silent. Thank you. And I now welcome Ms. Searle from the Maribyrnong Community Recovery Association. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Good morning. My name is Madeline Searle, and I am the President of the Maribyrnong Community Recovery Association, which we also call MACRA.
Thank you, Ms. Searle. I now invite you to make a short opening statement before I invite members of the committee to ask questions.
First of all, I make this submission as President of MACRA and in my personal capacity on the lands of the Kulin Nation, the custodians of Wurundjeri. I pay my respect to elders past, present and emerging, and I offer special respect for First Nation peoples on their country, caring for Marangbamoon, which is our beautiful Maribyrnong River. Let me first give you just an overview of MACRA. We represent river communities from the top to the bottom of the Maribyrnong River. Excuse me. We cover from Darra at Gwym down through Keilor, Avondale Heights, which includes the Riverview Retirement Village, Maribyrnong, the township, Edgewater Development, Ascot Vale, including the Ascot Chase Development, down to Footscray and West Melbourne, passing Kensington Banks. We take a whole of catchment view of the Maribyrnong River floodplain, and our focus is on mitigation, which is resilience, insurance reform, emergency planning and social recovery. We now have over 600 members and we continue to grow. I want to talk to you about three areas which completely overlap, but I'll try and consider them in three separate ways. The first is the role of insurance and the insurer, and in that I want to talk about disruption, the social contract, and the role of insurers in resilience. The second area I want to talk about is the unaffordability, unavailability paradigm, and I want to present that as a failure in adaptation and resilience strategies by insurers. That brings out the social justice and urban planning context, and it also enables the community to be particularly involved in emerging from this, out of disaster into resilience. And finally, I want to talk about adaptation in MACRA's communities and introduce 3 projects that MACRA has initiated arising from our disaster experience. And to do that, I'll ask to table 3 documents. The first is MACRA's position paper on emergency management, which is property-specific flood charts. The second is MACRA's flyer for our joint ticket proposal for the Melbourne Water request for proposal for flood mitigation solutions for the Maribyrnong River catchment. And the third is our newest initiative, which we call Built Resilient, which is a project for the creation of 2 properties in Maribyrnong.
Excuse me for a minute. Do we have the committee's agreement to formally receive and publish these documents? Yes.
Thank you.
Thank you, Ms. Hill.
So, Chair, would you like me to explore those 3 issues?
Yes, sure.
Okay. So, looking to the role of insurers and their responsibilities, the ICA presents the concept of insurance as playing an important role in the economy for protecting people and businesses from the financial risk of the unexpected happening. I think we're moving to a point where we are more expected than unexpected. I think that defines climate change. We now have a situation where insurers are saying they can't afford to pay for disaster, that the costs of reinsurance are behind that. And so what they're doing is they're putting up their prices and effectively then moving to the point of threatening to withdraw from the market because of unaffordability. Can they do that? Well, of course they can, but only if we let them. I think we've let insurers settle into an anti-resilience model, unlike most OECD countries. I think we need to turn our lens to seeing the problem as actually the solution. I see if we put insurers into resilience, give them skin in the game, then we start to turn around and move towards an affordable and an available insurance market in Australia. So to do that, I think insurers need to be disrupted by government. We're taking away the zero-sum game concept, that if their success is our failure or our success is their failure. I don't think that works. I think we need to move from that. Right now, Australia spends about 97% on recovery, 3% on preparation, and that's completely absurd and unsustainable, even without climate change. We have to invert that spending model, and the inversion is in contribution to resilience. I think we go back to the social contract. I think there's a mistake often with corporations that hold a licence, in particular insurance companies. It is not a right, it's a privilege, and I think the cost of that privilege is exercising the social contract for the benefit of the society that enables that licence. Now that sounds pretty lofty, but after my experience in Maribyrnong of being flooded, and I'm still flooded because I'm still trying to get my home back together again, I bring it down to 3 areas. One is just insurers running their business. The second is government standards for remediation. And the third is the as-is concept. I've said this before, that I have never seen an industry perform as badly as the insurance industry has performed in Maribyrnong. I can only speak of my community and my experiences, but there has been a complete failure in terms of offering and delivering financial product, which is insurance. I think if you were to compare other financial products like investment, superannuation, where there is a standard and a process, it's known and calibrated, insurance is not like that at all. It exists in some sort of vague ether where there's a willful reluctance of insurers to provide information. There's absent customer relationship management. There's a disconnection between contracted and subcontracted service providers, the builders, the remediators, and there's unidentified parties in the whole process. And then we have the appalling concept that is now becoming paramount, which is cash settlements. They just absolutely don't work. And then, of course, there's the time frame issue. And time is money. I have never seen anything work so slowly as insurance. I moved to remediation. I discovered when I wanted to remediate my house that I couldn't do it in a resilient way if I wanted my insurer to stay in the process, that I would need to cash out. That is just simply wrong. It has to change. Apart from the sharp practice of cash settlements failing to be a fair estimate of the cost of rebuilding, and Dr. Antonia Settle will speak to that later this afternoon, I'm sure, there is this idea that the cost of remediation does not need to be attuned to standards. When my house was being dried, very close to the end, I said to the remediators, and they were the second set, because the first set had failed by doing absolutely nothing. We're up to our second builder. I said, how do you know my house is dry? And they said, oh, well, you've seen us. We've got the machines. We've got the meters. We've blah, blah, blah. So I said, OK, but I really need to know that. So I'm going to get a second opinion. So I went to Dr. Google and I looked for concrete moisture specialists. And I just happened to speak. Number one was a fellow who said to me, oh, Madeline, they're not telling you the truth. There are standards. We're trying to put them together. I actually sit on the committees of the Australian Standards Boards, but they're not in play. Governments haven't put them into regulation. The important thing about that is the cost of remediation sits within the insurance as a sunk cost. So there is no incentive without standards for insurance companies to do the right thing. And what happens is that there's all these pretending remediations going on all over the place. I can look out from my window at home and see and feel all these houses that have had a lot of money spent for remediation that is completely fake. They are full of mould. They have not been rebuilt to standard. Some places have just been hosed and repainted, and people have moved in without knowledge of the history. That has to change. It does not work. It does not work. And the third thing is the general concept of as is, as I introduced. We need to move to a resilient way of having our homes. We can't stay the way we are. That makes sense on ordinary logical principles. But if you're facing a climate emergency and you're trying to insure a home, well, you have to scope that risk. And I think the way you do that is by building better. When I spoke before the Victorian Parliament Upper House Committee into the 2022 Maribyrnong floods, I think one of the things I said was that we have to work out a way to make our communities face up to resilient building, and I made a call for an establishment in Victoria of a reconstruction authority akin to the model in Queensland. We don't have that in Victoria. We're running behind. Up until quite recently, we weren't even going to the conferences in disaster resilience. We're catching up, but not fast enough. So I suppose that idea is how the business model is running. If you see the home as the centre of the business model for insurance, you've got overriders, you've got insurance regulation coming in. It's not really doing the job if I compare it to other financial product areas. If I look at the role of the banks coming in, they've been in a silent party. Over a third of Australia's houses are mortgaged. If you have a mortgage, you have an incredible investment with your bank in the integrity and the financial prosperity of your home. I don't understand why banks aren't more involved. I don't understand why, as a stakeholder, they're not pushing for more resilient homes, because they're paying for it. They're taking the risk of houses being damaged and customers not having a growing asset, which is to the benefit of the bank. I don't know why they're silent. They need to come into this game. Then you have obviously the resilience industry. We have the whole building industry, which is as I've observed in Maribyrnong, an exercise in waste, of putting products back into homes that you know the moment they're there, the moment water comes back, and we will flood again in Maribyrnong, it's just a question of when, it's all going to be ruined, and it's going to end up on the nature strips again, destroy people's lives again, and it's waste. We cannot do that. We have to have sustainable building practice, and I'll speak to an initiative by MACRA at the end of my presentation. The other thing is we need emergency management systems to cope as an interaction between the experience of being as prepared as you can, but never be guaranteed to be prepared. We don't have existing systems in place. Maribyrnong went into the floods with an out-of-date storm and flood plan. They still don't have an up-to-date storm and flood plan. That's just absurd. I have not done a check across other areas or even the 6 councils that MACRA works with as part of our whole of catchment, but I'm sure that I'll find many are out of date, and they're certainly not fit for purpose. They certainly don't take account of the new flood modelling. The second area I talk about is unaffordability, unavailability. Maribyrnong has seen a long-standing neglect from 1974 to 22. It represents a normalised discrimination in Western Melbourne, of policy failures, of victim blaming, the idea that there are people who deserve to flood versus people who don't deserve to flood. We have an outcome of this, which is the insurance becomes more and more expensive, and then there's the unaffordability issue or the unavailability, because people say, well, silly you built on a floodplain. Well, that is not a fair analysis of the overall situation. All of Melbourne is basically built on a floodplain. It's just that most of Melbourne is mitigated without realising it. We've got 2 great rivers in Victoria, well, down closer to the city, which is the Yarra River, which actually was a tributary of the Maribyrnong River historically, and the Maribyrnong River itself. The Yarra has been mitigated since the late 1800s. The Maribyrnong has never been mitigated, except by our Indigenous custodians who put in place fish catching, eel catching mechanisms and had used the river as an industrial corridor for thousands of years. So what I'm seeing is a neglect of a community that has predisposed it to climate change risk, and that leads to unaffordability and unavailability. So we are now at a situation where Melbourne Water, our catchment authority, has caught up after an 18-year gap and issued new flood modelling. And what that's meant is all of a sudden we've got about 1,200 homes that are now at flood risk. We have communities like Kensington Banks who've woken up to find that they are now on a floodplain, despite having bought property on the basis that it was not a floodplain. And that's only on the 2024 scenario. We move to the 2100, which is the climate scenario, and anybody that thinks we're going to be waiting for 2100 for this scenario is foolish at very best. So we get to the situation where we have whole suburbs and communities at risk, and we're trying to keep our homes safe and keep our homes the financial security of our homes, and that depends on insurance. Whole communities, whole suburbs cannot move. This idea that we can all shift to somewhere that's safe is absurd. We have a housing crisis. Where are we going to put the thousands of people at flood risk when we can't even build enough houses for current demand? So again, we need to make our communities resilient, and I say that insurance and banks need to be in the process to do that. For example, one of the things I observed very quickly after the Maribyrnong floods was that our catchment authority, Melbourne Water, was trying to institute what are called Section 173 indemnities on title. So having required a new property to be built to exacting standards, my house, a house on my boundary, is spending about an extra $300,000 to put it way up in the air and all of that, and I have no problem with that, absolutely fine. But on the other hand, I have Melbourne Water trying to put an indemnity that waives all risk for flood risk to property and to contents. That's absurd. That's an each-way bet. We can't have that. It's anti-resilient, and I call on Melbourne Water to comprehensively state that they are not going to put Section 173s on title, because if that exists on the title, the homeowner can't insure that property. And if you can't insure that properly, you can't finance that property. So it's an absolute stalemate. The third area I wanted to talk about is adaptation in Maribyrnong. One way I've tried to cope with my own personal disaster is to stay in the safe space of community service. I didn't choose to be sitting here or doing this. In fact, quite the opposite. It chose me. I have put my legal career on hold because I really can't do anything but face up to the community pressures I feel around me, to the people I talk to, and the very, very pervasive, silent grief of people that are now exhausted but still trying to get on. We come up to our 2nd year anniversary and almost nothing has been done. Practically nothing has been done. So what is MACRA trying to do? We're looking for opportunities. Part of that is because we have such a personal understanding. We literally have mud on our homes, so we see a way to change that by doing something. Doing something. Not standing around, not talking about it, but doing it. So let me move to the 3 projects that we are working on. The first one is what I call our position paper for the return of property-specific flood charts. And I understand the committee has had the benefit of having a bit of a look at this idea. What it does is it tells every single property owner what their resilience position is, which means that they know what a flood warning means for their own home. If you heard on the radio or the app, assuming it worked, and I have concerns with that, but assuming the warning comes in with due time, you know what it means. So the river level, the warning will say the river's going to be 2.7, 5.3, whatever it is. You know what that translates to your home because Melbourne Water has surveyed your property, discharged its statutory obligations as floodplain manager. So you can see whether the water level will mean it reaches your property or it's in your house. And that enables you to do the planning, to be safe, be ready. At the moment, the emergency authorities and Melbourne Water are saying this, but not giving the communities the information to make it possible. That's why MACRA is calling for the return of these charts. They were an initiative of Maribyrnong back in the 2000s. They mysteriously disappeared. We are calling for them to be restored in all 6 councils to practically enable people to know their risk, to be resilient, and then to save the money because they'll know what to do. They can do some planning. And they'll be planning within a resilient home in an ideal world. So that's our first big project. The second one is that we decided to take mitigation to our own hands. We know our world is getting more difficult in terms of flood risk. There are people in my community that the moment it starts raining, they stop sleeping. There are some people who haven't been able to cope with that pressure and they've sold. They've taken generally on a house value of $1 million, a cut of $200,000, and that will continue. So what we did was Melbourne Water initiated a request for proposal for mitigation solution studies. We found out about this, and so what we did was we created a joint ticket. We've brought together a community team with all of our community flood engineering experts, and we have a history of those who come from flood engineering backgrounds of Melbourne Water and its precursor MMBW. I'll call out the excellence of Jeff Crapper, Tony Jones and Ron Sutherland, who work with the community to inform them on data-driven analysis, and we're looking at understanding what the new flood modelling means for us. We've added a consultation, a community consultation, including myself and a specialist, Ross Colliver. I have then combined that with a private sector team, a company called Natural Decisions, which is an expert Australian consultancy firm. They've won a Eureka Prize for their work in natural resource management. And they bring contemporary hydrological and hydraulic modelling specialists, and they're coordinated by Dr. Anna Roberts, who's from Kensington Banks. All of us have skin in the game in the MACRA space. I then moved to invite an international panel of experts from across the world. Australia is not really doing flood mitigation, but the world is, so we need to learn. And I am not confident we are doing that. So what MACRA has done in our joint ticket, I've gone to Italy, I've gone to the UK, and I've gone to Holland, and I've found academics who work in these projects, who have lived experience and expert project, have actually done it, and we can show the work. And I want that brought into it. The community does not have confidence in the floodplain manager we have at the moment, Melbourne Water. That is not an assertion for the sake of it. It's borne out by the final report of the Victorian Parliament into floods. So this joint ticket of itself is not a stunt. This team, our team, could actually do the work. We could actually be appointed to do it. We have that capacity. And I look forward to a positive and constructive engagement with Melbourne Water to put us in the project. We do not need a multinational to tell us what to do. We have actually built a bespoke, appropriate and clever partnership of community, expert and international expertise. So that's our joint proposal. Our third thing is really practical. I'm calling it our Built Resilient project. It's basically two things. It's to build a property in Maribyrnong from scratch in the township that is gold standard resilient, that it brings together design that is desirable and for purpose. It then is built by construction that is sustainable and adaptable. All the resources, all of the materials, they can be used, they can be reused, they can be washed, hosed out, washed. And then livability. It has to be a safe property. It has to manage emergency management systems, and it has to be insurable so it can be financed. I have the benefit now of starting to realise this concept. I have the University of Melbourne. I've been absolutely delighted that Professor Sarah Bell, who's a professor in the Melbourne City's adaptation, City of Melbourne, working in bottom-up engineering solutions for resilient communities. I have the benefit of a PhD student, Dylan Newell, who's working specifically in resilient building as part of climate risk. And so I'm now looking for industry support. I frankly expect industry, with the support of government and philanthropy, to pay for this, to make Maribyrnong a gold standard example of resilient building for Victoria, for Australia, and frankly, based on what I've said about our team, to show the world that Australia is actually matching what they're doing and possibly even exceeding it. It will also challenge the idea I talked before about that there are people who deserve to flood so they shouldn't live there. Well, we have to live where we live because we can't all move. So Built Resilience is to show the community what can be done. So we have a brand new building, but then we'll find another property and we'll retrofit it to give that homeowner an opportunity to be better. Now, whether that might be to raise it or it might be to change materials, whatever it is, we'll bring those ideas together, building from experts in design, construction and livability. The thing that is so apparent to me, watching people try to restore their properties, is that they don't know the opportunities they have to hold on to their insurance by being resilient, to make it affordable and to be supported for that process, because they don't see it, they don't know it. And I want, through Built Resilience, to give the community and industry and government the opportunity to see a community responding. Before all of this happened to me, I probably had, as a financial services lawyer, an idea of regulation, of how things basically worked. But the Maribyrnong floods, the goodness knows how many cubics of water flowed through my house, and the visceral feeling that I still have, I can bring it up in myself right now, of stinking I call it zombie mud, because you put any moisture near it and it's instantly back together again. I see solutions out of opportunities, and I see a really practical way of trying to deal with this, to try and make assurance work. I actually think the problem that insurers propose to government of unaffordability is actually the solution, because they have to be put into the business. They have to have skin in the game. They have to stop saying it's a zero-sum game, because it's not. We have to be insured. We cannot live in a world that we can't manage risk. And frankly, the contract model of allocation of risks says that you put the burden of the risk on the person who can most control it. And that has to be, in a resilient thing, a two-way street. But where we have a situation where the insurance company is denying the homeowner the opportunity to be more resilient, then we have a subversion of fundamental contractual principles. You can go back to the 1300s in Italy to look at how insurance contracts actually formed and how they managed risks. And ironically, it all began with water. It was all about the transport of goods on ships. Amazing. So water is a defining feature of insurance and how you manage risk. We're not doing it very well at the moment, but we have an opportunity to do it really well because it's a better business model. I actually thought and have said quite often that insurance companies should be making more money if they actually ran their businesses properly, if they had proper claim management systems, if they actually managed their subcontractors. But they're not at the moment. They're absolutely not. I don't know how you could, if you saw the waste of time and money, corresponding human grief and the psychosocial costs of that, of how the insurance companies have responded in Maribyrnong. If I was a shareholder in an insurance company, I would be absolutely appalled that my interest was being so badly managed. And I say that too in the context of banks as well, of the shareholders of banks. They should be expecting that their banks would better protect their interest by encouraging insurers to enable the customer, the mortgagee, to be better protected. I see again and again and again that the problem is actually the solution, a change to resilient. So I think the grief I have felt and the grief I share, I'm almost a trustee of grief in my role in MACRA, is a way of facing up to the very, very personal fear, the existentialist fear of climate change in my own home, in my community's own homes. And from that, I sit here and I implore the committee to consider the ideas that you hear, but especially to challenge the business models of insurance companies as they will sit there and tell you, as they tell Dr. Molino's committee and your colleagues down in the House of Representatives, that it's all too hard and too difficult. I really don't think that's true. If I look at the experience I have had of all of the insurers in flood insurance work in Australia, in Maribyrnong, and how it's worked, it hasn't worked.
Thank you. Thank you so much, Ms. Earle. And I do want to acknowledge the grief and the trauma that you and the community have gone through and are still going through. And, you know, you shouldn't have to keep repeating that trauma, but we really appreciate you coming here today to tell us all your ideas and share some of those stories. And thank you also for all the work that MACRA is doing in the community and for the community. And with that, I'll open up for questions. If I could start with Senator Sheldon.
Thank you. And certainly join with the Chair, Ms. Earle. Thank you again for coming and speaking to us. It's so important for our deliberations in the committee, and taking account your evidence is going to be critical to the committee's success. Just going to that question, which has come up at previous hearings as well. This, almost that opening comments about insurance companies hot wiring in a failed system by saying, by realising loss, if you actually want to improve your property, if you want to actually make it more resilient. Would you be able to give us some feeling of any cost implications of realising that loss? Obviously we've heard evidence where 6 to 12 to 18 months. I was just in Lismore again last week, and having 18 months before you can build, but then having to realise the loss because you want to build back better, you want to have a more resilient home, has a massive impact on one. It makes it all but impossible for many people to actually take that opportunity to build back better, and also that effect on not making our communities more resilient. Are you able to give us a bit of a feel about some of the experiences of people from your group and you've seen in the community, and also some of that costs that would be realised as losses because of it getting dealt with now in cash amounts rather than additional building costs that would be realised further down the track?
Well, at the moment, to build in a resilient way does cost more, but that's a function of those products not being widely used. I think it's the idea that if we improve the market for those products, the cost will come down. And I also think there's, for the reasons we are working on the Built Resilient project, is to show what is possible. I challenge the idea that short-term cost is too high a barrier to long-term resilience. I think if people had the opportunity, they would not think of it as a failed or a waste of money, because we all know so well that we are going to go through this again. And so the idea of spending more money or having our service providers or our government participate in that. So if I look at people around me that have had to go into an emergency renovation, many people in this room will have gone through renovation projects, and it is a very stressful endeavour. It takes a lot of planning, things go wrong, you have to be adaptable. Imagine if you're thrown into that because of an emergency and you are suddenly having to work out what to do. I often say I'm a reverse flood engineered specialist because I've had to work backwards to try and work out what to do to move forwards. Again, part of that is the business of how insurance functions. But there are solutions, there really are, and I think if people had the opportunity to use them, many would, because they would just be thinking, I don't want to go through the grief of waste. I want to live in a home where I can go to sleep, and if the flood warning comes in, I'll be able to do something. Maribyrnong was the largest single urban disaster in Melbourne in over 50 years. Very few people actually know that. The cost of that is extraordinary. So the cost of trying to make that less by building homes, retrofitting homes, has to be a better spend of money. And I just think we have to move it. I was gobsmacked when I said to my insurer, right, okay, well, I'm going to get a certain amount of money. Okay, that's my claim. So, okay, but I'm not going to put it back as it is, because that's just building in thing. I'll top it up if I have to. They went, no, we're not going to do that at all. You have to do it yourself. You have to move to cash settlement. And then, of course, the evil of cash settlements. So I think we see the model of bushfires.
Would you mind just on that question of the evil of cash settlements, what sort of figures that you've observed, what that evil would be? And
the example I give is a wall. If you look at that wall, if that wall's been destroyed in a flood, the square metre, to get that square metre back to there, solid, painted exactly as it was before, the insurance company will say it costs about $50. You know, in reality, that's got to be double and progressively moving to triple. And the way they do that is that they have a panel of builders who are, like all panels, who've been brought onto a panel. What they do is they're screwed down to a price. So when you do a cash settlement, you will get that price because that's what the insurer's scope of work is saying. But what subsequently happens is that the builders catch up the real price and the real value by variations. If you cash out, you miss out on that. And because you have to cash out in most cases, because you want to do something differently, or the delays are exhausting you, or you just want to get on, you do it. And so the other aspect of the cost is that we have two teams running for cash settlements. So you have the insurers team, the builders, all of that, the experts that are all sitting there, and to make yourself have a functional claim experience, you have to bring in your own team. You have to bring in your own builders, your own experts to cross-check. You imagine that in any other financial product? that you have to bring in your own actuaries and your own investment managers to try and work out how to make it a good financial outcome. So when you spoke of the cost, of sinking that cost, I say when you look at all of the other sections of cost, we are still going to be far, far ahead by making us resilient and the cost of that. And again, insurers have to be part of that. They can't just head off and say, not our problem. They just can't. Go back to shareholders. They can't waste shareholders' money.
You may be aware of this, but I'll just see how we go. There was during a hearing in Sydney, we heard evidence regarding reinsurance costs and and what makes up some of those reinsurance costs. I might add we're still trying to get that to be a lot more transparent than it presently is. But one of the pieces of evidence was regarding broker commissions. They start on average of 20%. We received evidence that in many cases that they'd actually gone up to, in some cases, 40% of the insurance price. John Trowbridge, a respected former actuary and insurance regulator, suggested reducing commissions to around 10% during the hearing. He said 20% is more than brokers need. They pay part of that to the strata managers. The brokers should be able to exist on fees of the order, let's say, for the sake of this argument, which is not to be too precise, but something of the order of 10% is all they need. That 20%, when we're seeing insurance prices going up well above inflation, the 20% from the evidence we received from a number of insurance companies was for the cost of doing brokerage work. But when you're going higher than inflation, when you're keeping the 20% on the above inflation increase in insurance premiums, then it seems to be a real loading going in there without thought about actual cost or actual value. Have you got any views about the reinsurance market or the brokerage fees?
Well, two things to that. First of all, has anybody here had to arrange a wedding? If you go to get a wedding cake, it costs magically so much more than if you just walked into the shop to buy the same cake. Insurance is replete with this supercharging of costs because it's insurance, because it's not a managed subcontracted process. So absolutely, there is no need for those egregious and usurious approaches to costing in insurance. As to reinsurance, well, I've spoken to quite a few people, and one of the things they suggest to me, one person in particular, was saying that insurance companies have a really good way of shifting the costs to make it seem that they are absolutely at a financial loss. Now, I'm not a financial analyst, but I do know businesses are very capable, large businesses are very capable of moving profits and loss to suggest that they are in a position of pain. So I encourage the committee to get to the financial analyst who can look to these sorts of things, because I am not convinced that it's that we have an unaffordable paradigm. I'm really not. And I say that because I've seen it at such a ground level that gives me an insight into how this must extrapolate to extraordinary waste. So, wedding cake. We should be able to just buy a cake. The fact that it's called a wedding cake should not mean that it comes at an inflated premium.
Chair, I'd like to ask more questions, but I'll see how we go for extra time, but back to you.
Thank you, Shannon Selden. Could I go to you, Senator McLaughlin?
Thank you. How many local government areas do you overlap with your association?
Six.
6
minutes, yes.
And do you hold a view of their sort of culpability in their planning, or what's your relationship with them, and what's the view of the association on their contribution to solving the problem or their role?
Well, I think it's fair to say that we have to use the human body example, we have a very fat and lazy body that needs to work out a way to live to a ripe old age. I think there are so many things that have gone wrong in terms of urban planning, but at the same time, I spoke earlier of the idea of the deserve to flood, don't deserve to flood. So I think each of those municipalities need to look at how they do things, but not go into a screaming panic about thinking that they can't actually solve the problems. And that's why we've offered this very specific thing of property-specific flood charts, so we can work out what the risk is, and home by home, inch by inch, work out a way around it. If I look at the example of Kensington Banks, those properties were sold on the promise that they were not on a floodplain. Clearly, that should not have happened, because it was reasonably forecast. You could reasonably forecast that they would be at flood risk. So we have just had an aggregation of failure of due diligence by developers, by councils, by communities, and from that we just have to get better. I know that's simplistic, but
sort of anticipated my next question. So if I was a new purchaser to the market, because there's obviously two issues: someone wanting to live there and people who have bought under different or past conditions. How do I know at the moment whether I'm taking a risk with buying a house in a block? I'm a South Australian, which is a slightly different jurisdiction, and I know how I can do that. It would be on my title, for example, that there's risk of flood, and I can manage. Well, I can make an assessment of my risk and the price I pay. How do I do that in your part of the world?
It's fairly similar. Obviously, we have zoning that tells you you're at flood risk, but it's not necessarily up to date.
Right.
And I don't think there's sufficient community awareness of flood risk generally, certainly in an urban environment. I think one of the problems Maribyrnong floods have had is we just didn't make sense. The Rochester floods made sense, the Lismore made sense because of rural tragedies, and it seems more logical. So I think we just need to build a better awareness of risk of property generally. We're seeing that now with climate change in terms of our heat risk. We can see it now in terms of our flood risk, and of course in different areas our bushfire risk. So yeah, we need a way of a property being described at risk and at opportunity and at benefit. So
to the extent that you're aware, and it may be an unfair question, so push back. Are you getting a sense that people are deciding to leave the community because there's too great a risk, and from risk, cost of living in the community with holding property, or people seeking to be resilient and adapt?
I think humans have a fondness for avoiding a problem, whether it's for a good reason or a bad reason. So yes, there are certainly people, and I will not judge a person who decides to sell their property and move away if they can't cope with that or they don't want to cope with that. I think the response I would put to those members, and I have good friends that are contemplating that at the moment, is to say, put your energy into the community voice for mitigation, for ways to diminish the risk. So that would be my way of putting human energy, ground level.
Just so I understand sort of the voice of your organisation, could you just quickly take us through how you form a view by process? I don't need it in intimate detail. I do notice you've got, which the reason why I asked the question, I know you've got community consultation teams. Could you just give me a sort of an overshot of the wiring of how the view gets formed, because you have a very large area, and I noticed you've got people dedicated to that, and I just like to understand.
Well, this is Well, this is a vision for the future, for a project we want to be involved with. But in terms of getting a view of our community, sometimes we are a small organisation representing a larger group. We are grassroots. We are kitchen table. We are walking around and talking to people. We are listening to our community. Does it have the full throttle corporate governance that I'm used to in a legal services area? No, it does not. but we are authentic in the sense that we have had such an incredibly awful shared experience that we have a collective knowledge. And we also have a forecast knowledge for those in our community that we've reached out to capture, like Ascot, Chase, Kensington Banks and Edgewater, and further down into Footscray and West Melbourne, that we don't want them to go through that experience. So we are going into those communities and saying, look, we need to raise a community voice for the following reasons. And it's not just an economic risk, it's a safety risk, a future opportunity.
Thank you, Chair.
Thank you
back to
very
you.
much. Thank you. Ms. Searle, the committee's been around to Northern Rivers and Brisbane and spoken to people there who have similar experience as to what your community has, especially with insurance companies who have put people through really onerous claims processes. I'm just wondering if that's been a similar experience. I've read stories that it has been a similar experience with the community. Could you share just a couple of those experiences of people having to deal with insurance companies on top of the trauma that they're already dealing with the floods?
The stories are the same. There's a remarkable consistency to it. As I say, it's the business model of obfuscation. I think of an example of a woman I've gotten to know very well and is an absolutely marvellous friend. She's an elderly Italian lady. She represents the triumph of Australia as a migrant experience. She lives in a house she's now an elderly widow. She was flooded with a couple of hours' notice, as we all were in Melbourne. And her experience of the insurance began on the first day when a fellow turned up with, as she says, bright white sneakers, did a swing around and then disappeared. And what has ensued since that point is that she was cash settled out for a pittance. She still has mud in her house now. It's never been remediated. I've brought in independent experts that I'm now aware of, and they were ashamed to see what their industry was doing. And yet that was done by a reputable insurer, and they would have spent a great deal of money doing that. So we're now having to reopen that case and get this woman a fair result. And yet she would try. She has that endeavour of an Italian migrant who's built businesses. She has tried so hard. She has experienced what I call the failure of e-recovery. She's incredibly articulate, but at the same time, she was unable to connect with her insurance company to know what was going on. I often, I've told her that what she's had is the elevator principle. As she's found out more, she's had to go backwards and try and undo things. Her insurance company brought in people to do the remediation. They turned up, they put a few machines on, they turned it off after a couple of weeks because they told her that there was a house around the corner that they needed to do and they'd bring the machines back. That is not how you clean and dry and get hygiene safety. Just gratuitous processes.
And do you think that's been the general experience?
Oh, I do. I look out, Maribyrnong has a substantial ESL community. Our largest ethnic group is the Vietnamese community. And I just know, apart from all the people I speak to and have become very close to, that they've had incredibly bad experiences and so many don't know. It's the unknown unknowns. They are in a situation where they've either cash settled for too little or they've let their insurer do the work and they've failed and have built-in problems. For example, so many insurance policies have exclusions for mould and for not having building done to code. And yet that has repeatedly happened, not through the fault of the actual victim, the flood victims, because we are victims. It's because the insurance model has built that in by the cash settlement and the inadequacy. So you have to cut corners to get your home back. Or you don't know that you haven't been remediated. So when the insurer comes along, if you get insurance again, as friend will, I say to her, you cannot stop now, because if you try to just leave it as it is, what's going to happen when the flood comes again and you try to claim again, because you will continue to pay very large sums of money, they're going to turn around and go, oh, sorry, your house still has mould. That should have been fixed, even though that was a function of a failure of discharge of duty by the insurance company.
Do you have a sense of how many in the community are unable to get home insurance or are not insured for flood cover anymore?
I think at the moment we are still getting renewals, but at considerably increased premiums.
Yeah.
But I think that's going to sort of fall off a cliff fairly soon, because we have the situation that was unknown, in that cash settlements seem to give insurance companies the opportunity to not offer that insurance product the next time around. So they might reinsure it quickly because you're in the timing process, but subsequently they'll go, sorry, we cash settled, we decline now to offer you insurance. And that puts you in the situation of trying to find insurance from someone else, and they'll say, have you been declined insurance? And you'll say, well, actually I have. So then you're building an adverse load, again, through no fault of your own.
So the cost of insurance in Melbourne has gone up by more than 21% since October 2022. That's 4 times the increase in the CPI over that same time frame. And in fact, what we have been hearing is that actually the rising cost of insurance is impacting on inflation itself. I'm just wondering, because of the increased premiums that the community is kind of being forced to pay, do you know how people are faring? Like, would there be people, because we heard this in Brisbane and in the Northern Rivers as well, the people have had to make really tough choices in terms of, paying payment or, making ends meet or cutting back on many other things. Are those kind of stories that are coming across as well?
Absolutely, yes. First of all, I'll say a substantial reason for that increase is due to mismanagement and effectively greed. So stand on that. But the actual consequences to a family's budget are absolutely dire. I look at Kensington Banks. We have families there that are absolutely at the limits of their capacity to just financially cope. And all of a sudden they're being told, right, you are now in a flood zone, so your insurance premiums are going up. So trying to work out how on earth they find hundreds and sometimes thousands of extra dollars to keep their property insured is an absolute terror, So the psychosocial distress in Kensington Banks is horrible.
So from Kensington Banks, what you're saying is that their premiums have gone up as well after the rezoning?
Yes, they are starting. Yes, and they will. Similarly for Maribyrnong, similarly. And in fact, I have a situation where we have a retirement village in just up the river from us in Avondale Heights that is presently uninsured. So we have people in a retirement village, our elderly, they're my most vulnerable cohort, they're not insured. They are being told by the owner of the village that they are self-insuring. We have been calling relentlessly for an explanation of the financial instruments that underpin that self-insurance, but they're silent on it. So yes, so the stress of they're not insured because they are not being told, or the Retirement Village Act is an absolute disgrace. Then you have people who are being forced by the function of having a mortgage to be insured, and they have no choice. So people are going to grief, grief.
And what have the state and federal governments done since October 2022 with respect to climate adaptation and resilience measures to help your communities prepare for future weather events? Have they come to the party and kind of helped people or done anything?
No. And that's why MACRA has headed in the direction we have of offering possibilities and good ideas to say, just do this. You guys take the credit, you head off and get the awards. We just want our homes better and safer. So no, I'm not seeing that. And the example I gave before of Melbourne Water as a statutory agency of the Victorian government deciding that the first thing they should do is put in place indemnities. shows you that they are contradicting that. So, no, I haven't seen that.
So we're looking at, obviously, specifically climate-driven disasters, which we know are going to increase in frequency and intensity, and, the risk of that in terms of insurance premiums. And of course, we know that fossil fuels are the biggest cause of the climate crisis. And we, like people have suggested, that various organizations need to come to the party if we want to change things. And you have emphasized how insurance needs to change. So I just want to put to you, should fossil fuel corporations also be part of contributing to adaptation, resilience, and to the damage that is caused after, or to insurance as well? Since it's kind of the polluter pays principle I'm talking about here. We use that principle in many things. Should that be something that should happen in this case as well?
Yes, if you're part of the problem, you have to be part of the solution. And I maintain that there's good money to be made by good business models that create resilience. And I think if the community, if the couples, the families that I know around me, and the ones I don't know yet, as I'll progressively meet more and more as we, become a greater collective voice, I know that if they can change their lives by support, good regulation, good company processes, then we will be, from ground up, solving these problems. There is obviously a role for top-down, part of the problem, part of the solution, but you've got to have an awareness. And when the community realises what's possible, that creates a voice and a pressure that is going to make
that change. Yeah, well, thank you very much for being that voice on behalf of the community. We've run out of questions, but if there are any other questions, we will put them to you on notice, and the responses to those will be due by the 14th of October. Thank you so much again, Ms. Stirl, for being here.
Thank you for the time to air these issues. Thank you.
Really appreciate it. Thank you. The committee will now suspend for morning tea, and we will resume at 11:15. I now welcome Commissioner Stirland and Mr. Turner from the Productivity Commission. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you each please state your full name and the capacity in which you appear today?
Hi, I'm Barry Stirland. I'm a full-time commissioner at the Productivity Commission.
My name is Stuart Turner. I'm a director at the Productivity Commission in the Climate Change and Energy area.
Thank you both. And I invite you to make a short opening statement before I invite members of the committee to ask questions.
Thank you, Senator. Climate change will be one of the major issues affecting Australian society, its natural environment and economy and productivity in coming decades. And that's why the Commission's focusing attention on this area. It will require significant expenditure from households, businesses and governments, both on mitigating and adapting to climate change, including to meet our international obligations. It will be critical, therefore, to do so in the most cost-effective way, both now and through this multi-decade investment. Climate policy is a key area of focus for the Commission. Climate and energy was one of the issues that we focused on in the 2023 Productivity Inquiry. There's a whole chapter on that and we've completed several inquiries relevant to this issue. And earlier in the year, in recognition of the importance of the area, the Commission identified climate energy as a priority research stream. A key part of responding to the challenge of climate change will be adapting to its impact. Among other things, climate change will make floods, cyclones, fire and other severe weather events more frequent. The task of managing the risks of these events will therefore become increasingly important, and this is the focus of this Select Committee. I'll turn to my colleague Stuart Turner to outline the PC's basic approach to these issues as it relates to the impact of on insurance costs and availability.
Thank you, Commissioner.
Thank you. I'll just briefly recap some of the points in our submission to this inquiry. First, managing natural disaster risk is a responsibility that is shared between households, businesses, the community and all levels of government. Effective natural disaster risk management includes taking measures to reduce risks, pooling and transferring risks through insurance and bearing some level of residual risk. Private insurance plays two important roles in natural disaster risk management. Insurance provides a mechanism for people to pool the risks that they face and to reduce the financial impacts of disaster events when they occur. And through insurance premiums, insurance sends signals to households and businesses about the risks that they face and gives them a financial incentive to reduce those risks. Increasing insurance premiums have led to political pressure for governments to step in to reduce the price of insurance. There are a number of things that governments can do to reduce insurance premiums and to reduce the level of risks that are faced by households and businesses. The first is the reform of inefficient taxes. State and territory governments levy a range of duties, charges and levies on general insurance premiums. These taxes and charges increase the price of insurance, reduce the level of insurance that people take out, and are an inefficient source of revenue. They should be phased out and replaced with more efficient revenue sources. Second, governments have an essential role to play in providing information on natural disaster risks. The PC has previously suggested that this could include mandatory disclosure of risks at the point of property transfer, and there's also the general role of institutions like the CSIRO and the Bureau of Meteorology in providing information on climate-related weather risks to households and businesses. Third, governments have a role in funding measures to mitigate natural disaster risks. In our 2014 report on natural disaster funding arrangements, the PC recommended significantly increasing funding for natural disaster risk mitigation. Increasing investment in mitigation could, over time, significantly reduce the natural disaster risks faced by households and businesses and ultimately reduce their insurance premiums. In addition, they could reduce government's exposure to the cost of natural disaster relief and recovery. Governments can also use tools such as building codes and land use planning regulation to ensure that buildings are resilient to natural disaster risks and are built in lower risk locations and to discourage development in high risk locations. Finally, the PC has previously commented on measures that government have taken to directly intervene in insurance markets to reduce the cost of insurance premiums, such as the cyclone reinsurance pool. These types of measures can have a range of unintended consequences. First, they can distort investment decisions to the detriment of productivity growth and can inadvertently encourage communities to make decisions that can increase the costs of future natural disaster risks. Second, there can be fiscal impacts. Arrangements like the cyclone reinsurance pool expose the Australian government to significant contingent liabilities, which in the future can have real and significant costs to government budgets. For these reasons, in the productivity inquiry, the Advancing Prosperity Report, and reiterated in our submission to this inquiry, the PC recommended that over the medium term, the Australian government should set a time frame for phasing out the cyclone reinsurance pool. And I'll leave my remarks there. Thank you.
Thank you very much. Senator Sheldon.
Some of the evidence that we've received in, and thank you for joining us today. Some of the evidence we received in some earlier hearings, I'll just go to it. And I particularly note that, quoting in your submission that saying that insurers have developed detailed data sources and sophisticated analytical techniques to assess the risks faced by property owners and are increasingly able to set premiums according to the location and characteristics of individual premises. But that tends to clash. I just wanted to see what your views are in some of your investigations, your studies and your reports. In that quote, We've also received a lot of evidence during the hearings from that clashes with that sort of that hypothesis put forward. The Mayor of Merwere Shire Council told us they invested $11.5 million in a flood levy in Charterville in 2011 and spent another $12.8 million diverting a river in 2014. There's been grants handed out for house raisings, and there was a major flood in April and not a single property inundated, yet their premium's gone up by 300% since then. Now, we've heard of other people about homes on the hills that have never been flooded seeing large premium increases because of the postcode they live in. Is there a real question about whether the insurers' capabilities are actually sophisticated enough? Because wouldn't the hypothesis be, wouldn't the logic be that these sorts of things shouldn't be happening with these massive insurance increases in those circumstances? To either one of you.
Well, I mean, I'll start off. One of the key roles of government in this area is to provide accurate information, and so, and I think you're going to be talking to some of those agencies and some of the issues that go to there. So, providing the right information that's effectively and efficiently provided by the government is critical. We would, you'd want the competitive pressures in the insurance market to work towards allocating that risk effectively and charging for it effectively. Some of those measures, they're not all, they can be imperfectly understood, but we would also want to rely on the competitive dynamics overseeing the insurance market to make sure those are transferring through to consumers. But my colleague Stuart might have some other comments to make.
I think we're not in a position to comment on specific cases, obviously, but I would emphasise what Barry said, that competition should encourage the insurance providers to use that information effectively. And if there are people on the side of a hill who are being charged high premiums, then they should have an incentive to go and seek out lower premiums from other providers. If those providers don't exist or they're not active in that market, that could be an issue, and that's something that I think is really a role for the ACCC to monitor and consider the level of competition in the insurance market.
Okay. And I appreciate that, talking about the specifics of those examples I gave you, it's difficult to make an assessment specifically of that. But the broader question of we are hearing evidence after evidence. I know from the other place with a house inquiry as well that they're hearing very similar examples, and where insurance companies either are seeing an opportunity in that market for them to, regardless of the mitigation, to incredibly increase premiums. If that was happening, it does go to a question about as a market, and there aren't alternative people that are in that market. That does then go to a question whether the market's failing or not, doesn't it? In certain circumstances, failing.
Well,
like, it's not an ACCC question. It's if there's only one company insuring in there, and it's massive increases that are taking place when there's evidence of mitigation taking place over a considerable period of time.
Well, monopoly is one of the classic market failures, and if there is a monopoly in a market, then that will tend to lead to the market outcome not being efficient. We're certainly not here to go into bat for the insurance companies, but my understanding is that insurance premiums consist of a combination of a number of factors, including natural disaster risk, but also things like the value of property. So as house values go up, then the cost of insuring them goes up. Likewise, the costs of construction have been increasing over recent years. I imagine that flows through to insurance premiums. So I suppose it's technically possible that natural disaster risks could go down and insurance premiums would not necessarily go down at the same time, because there are a number of factors that go into those premiums. But the public policy issue, I think, is competition? Is there competition in the market? And if not, what can be done? What should be done?
Well, this might just go to a broader question, and this question of insurance prices and premiums. You may have been in here when I asked the question before. But during our last hearing in Sydney, we heard evidence of broker commissions starting at an already exploitative flat rate of 20%, and insurance company after insurance company giving evidence of that's the market norm that's charged, or a regular price that's charged across the market in many cases, and but we also heard evidence that sometimes those brokerage fees go to as high as an outrageous amount, like 40%. John Trowbridge, who is a respected former actuary and insurance regulator, suggested reducing commissions to around 10% during the hearing. If you got in any of the inquiries you've done, if you come to a view about the rates of commissions, because if they seem to be largely all 20%, premiums are going up at the moment above inflation. So that's 20% on top of the rate above inflation. We'll give an evidence that those brokerage fees are based on personal labour input and knowledge. This is a bit of a worrying trend. If it's 20%, sometimes as high as 40%, and highly respected individual in the market is saying it should be more realistically around 10%.
I don't think we've got any research that would go to that level of detail. I think our general point, wherever possible, is to address an issue at its source rather than regulating the insurance price outcome. That can have a lot of unintended responsibilities, unintended implications. So I think those particularities of how a market works and the role of brokers is an issue that is looked at in several financial market contexts and probably needs to be addressed to those the people around that, to do with the information being provided to people so that things are transparent, that all the issues we've dealt with in some other industries are dealt with effectively, and that should be where you focus, not on regulating the outcomes of prices where possible in this area, because that can have unintended effects.
Like reducing the premium.
It can distort the premium from, can detach it from the risk being insured for, which is the key policy.
Yeah, these are brokerage firms that are charging everybody, going out to a pile of insurance companies and saying, we're charging you all 20% of the premium price. It's a flat 20%, not a flat amount, flat 20%, which some might say, and reports have said that that's also an incentive to not necessarily find the cheapest insurance premium either. There is a suggestion of that. And I know your comments about, I'm not making a comment about it either way, but noting that you've made comment about government charges, where there's a set charge by the market, which is going across the market, is a minimum of 20%, does raise similar issues that you're putting to me or putting to the committee regarding government charges as well. To me, but that's, you might want to make some observations on that, or I'll make a comment. I'll leave it to you guys.
I think a starting point for the PC would be to examine whether there are barriers to new entrants coming into that brokerage market. Is there anything stopping new entrants from coming in and charging 15% or 10%? If there are barriers, then there's a role for government potentially to address those barriers. If there is anti-competitive behaviour among the brokers, then there is a role for government. But we would say at the PC that the number itself is not the objective. The objective of public policy should not be to have insurance brokerage charges at a certain number. It should be for there to be competition in that market, options for consumers, and also for brokerage to perform the role of intermediating information on a complex product to consumers.
If I've got time for one quick question, yeah. Just going back to the earlier comment about the 2014 Productivity Commission report and going to the question of mitigation. Have you had an opportunity to observe about, now that there's the Disaster Ready Fund and its operation, if you come to any conclusions about the operation of the Disaster Ready Fund in more recent times? Is that...
We haven't looked at it closely, Senator. So the recommendation in the 2014 report was to increase Australian government expenditure on natural disaster risk mitigation to $200 million, and my understanding is that's the annual allocation to the new program. But we haven't looked at any of the specifics of the program. The PC's done a lot of work on recommendations on how to do climate change adaptation and public infrastructure investment, and those general principles of doing thorough cost-benefit analysis would flow through to, would inform any assessment that we would have of that program. So the general PC view would be that the spending of that money should be governed by principles of cost effectiveness and seeking out the most efficient ways and the highest bang for your buck, essentially, when spending that money. But we haven't looked into the details.
Thank you, Chair. I might ask a few questions before passing on to my colleagues. Just want to ask a few questions about stamp duty. Stamp duty is by and large considered to be one of the worst taxes that there is, and we have heard from a number of witnesses in this inquiry that stamp duty on insurance should be removed. So I guess my question to you is, if Australia is experiencing a prevalence of underinsurance, do you think removing stamp duty is one of the easiest, quickest things that could be done to help with this issue?
Reforming inefficient taxes and charges on insurance would directly reduce insurance premiums, and yes, would be the easiest, most direct measure that governments could take to reduce premiums.
So removing stamp duty would be?
Stamp duty, emergency services levies, other charges on, other state and territory government charges on insurance that are specifically levied on insurance.
And what role could federal government play to support states removing these stamp duties on insurance?
Tax reform is a very broad subject, Senator, and I would not venture to make any specific recommendations on the role of Australian government funding or Australian government.
But I'm asking
finances.
about this specific tax of stamp duty on insurance. That states run that, but what constructive role could federal government play? Because we are, experiencing, or people are experiencing, a bit of a crisis on insurance. Their premiums are going up. We just heard earlier that people are struggling on how to pay their rising insurance costs. So if federal government could help in that sense, what role could they play in this?
I wouldn't go to the details of that packaging, but I mean, one of the first roles is sort of calling these issues out. It affects, most of the issues are both captured within a jurisdiction, the negative consequences of that. The residents of a state are the ones that are paying the higher insurance as well as collecting the revenue. So you don't want to understate the role of being clear here. This doesn't inherently involve cross-border issues all the time. And you would just make the general comment that the federal government and states collaborate on a range of issues. There'd be a range of points of leverage beyond that, but the first thing to really emphasise is, a New South Wales resident or a Queensland resident is both is paying the stamp duty, and that's affecting the budgets of those states. So being really clear about that allocation and the opportunities for reform, even within jurisdictions, would be an important first step. And then the Commonwealth always has a range of issues that it sometimes deals with in a overall national way, sometimes bilaterally with states that could be part of this, but I'd start with the jurisdictions imposing it.
Okay. We have also heard again and again from witnesses, obviously, who've been experiencing these climate-driven disasters more recently, about how unaffordable insurance is becoming, and we have also heard about places which people are not getting insurance. They're not being insured or finding it really hard. But there is no, data that is collected, as far as I know, to understand the whole picture. Do you think that we should be collecting better data on the availability and affordability of insurance to get a lay of the land, given that these climate-driven disasters are only going to increase in intensity and frequency?
Senator, it's been a little while since I've done detailed data analysis in this area, but my understanding is that the data on the cost of insurance is collected by the ABS as part of the standard basket of goods for the CPI calculations. I know that the Actuaries Institute has published data on the availability and affordability of insurance. At the PC, we would always say that data is great, but it's not free. Collecting data does require resources from government, and you need to carefully weigh up whether the costs of collecting that data exceed the benefits of having access to it. But in general, at the PC, we use a lot of data, and we would think that it would be better to have more information on the costs of insurance, and particularly on the potential areas of market failure, such as competition and access to information.
It's also, I guess, I specifically want to ask about underinsurance, because we're hearing more and more that people may not be insured. I mean, that has risks on its own, and that data, as far as I know, is not available or collected. Would that be something that you think is important, given the risks of people not being insured or being underinsured?
I think the Australian government, state and territory governments would have an interest in understanding the level of private insurance in the community, so they would be aware of the potential for uninsured damages in the event of natural disasters. We know that governments are often effectively the insurer of last resort for people who don't have insurance. So if governments don't have good information on the potential liability that they're facing, then they are less able to make good decisions. So I think that would be a useful input into some government decision making.
The Law Council of Australia has said that your submission suggests that there is currently no market failure in the insurance sector in relation to the management of climate risk, and that government regulation of insurance markets should be avoided. That is their comment. They argue the opposite, saying that there are clear signs of market dysfunction in the insurance sector, with skyrocketing costs of premiums in recent years indicating a trend towards potential market failure if the impact of climate risk on the availability and cost of insurance is not properly managed. So how would you respond to that? And are you getting it wrong by saying that there is no market failure?
I'd say first that the PC does not say that there should be no regulation of the private insurance market. The insurance sector is rightly subject to all of the standard corporate regulations in Australia, as well as specific, sector-specific regulation through ASIC and APRA. And that's entirely appropriate, and we're not calling for deregulation of the insurance market at all.
That wasn't my question, though. I guess my question was about you saying, PC saying that there is no market failure in the insurance sector in relation to the management of climate risk. and other people refuting it and saying there is a clear market failure when insurance premiums are skyrocketing way faster than inflation.
In economics, the term market failure does have specific meanings. It doesn't mean that the market outcome is not the one that I want to see. Market failures include monopoly or oligopoly, so market concentration that reduces the potential for competition, imperfect information, so where consumers don't have access to all of the information that they need to make good decisions. I think in the insurance sector, there is certainly the possibility that there are market failures in relation to information, and we think that governments have an important role in providing that forward-looking information on natural disaster risks so people can understand the risks they face and make good decisions about how they manage their risks, including through insurance. So the PC doesn't say that the market for insurance is functioning perfectly efficiently. There is the potential for market failure. However, the fact that premiums are high in some areas is not an indication per se that there is a market failure. In fact, it could be the opposite. If premiums were very low in areas of high risk, that would be an indication that the insurance market was not functioning efficiently.
But I guess you are aware, and a number of submissions and witnesses have pointed out, and we know that the 2022 floods in northern New South Wales and southeast Queensland were the costliest insured event in Australian history. And I guess it won't be the last of this either, since, like I said earlier, we do expect to see an increase in climate-driven disasters. So surely if we are in a spiral of insurers hiking premiums to just keep covering their costs and on top it up with profits, with disasters that are hitting more frequently and with higher intensity, leaving more and more people either underinsured or uninsured, surely that becomes unsustainable, and it is very far away from a perfectly a perfect market. It is quite far away from that, even if you don't admit that it is a market failure. There is an issue here. Would you acknowledge that?
I think the underlying issue, which is that climate is going to impose increasing costs, is there, and it's unfortunately there, but it is there, and it's going to increasingly dominate the future. So our response as a society has to be as broad as possible to that. Who's best placed to manage that risk? The ones efficiently managed at the government level, which is not always spending. It could be efficient regulation of location, building of common infrastructure in an efficient way and a resilient way. We've got to use the full set of tools to manage that. I think our comment is not that there's a perfect market there, and so I don't think it's characterised exactly right. It's saying that there is wide coverage of insurance. That sort of approach is there. We would, I think I'll just reinforce Stuart's comment that the rising cost is not itself an indicator of market failure. So really need to be careful about those indicators. Issues of poor information amongst consumers, market concentration, market evidence of higher than normal profits, this sort of thing, and use the right way to address that fundamental concern. Start and then work out who's best placed to allocate and bear that. Who's best placed to bear that risk? That's an inherent risk. The costs are increasing, and it's an issue of how best to allocate that.
Yeah, I mean, costs are increasing. Of course, it's becoming unaffordable, but it is also leading to people not insuring, being uninsured or underinsured. And is that a risk that you would consider to be a high risk?
It's certainly a cause of hardship when people are facing very high costs, and we at the PC would always acknowledge that it's It's very stressful for people when their insurance premiums or other costs increase. Our starting point for public policy analysis would be that the way to address these problems is to look at the root cause. So that brings to mind really two angles that governments can take, and one is the general social safety net that we have in Australia. That's the way that we generally address the range of hardships that people face. And the second is to directly address the causes of natural disaster risk, including through Australia's participation in international emission reduction efforts to hopefully ultimately reduce climate risks over time, but also more directly to take steps to reduce localised natural disaster risks, floods, fires, etc.
That's through adaptation. Is that what you're kind of alluding to? Yeah.
Adaptation, yes, and directly
Resilience.
addressing, directly addressing the natural disaster risks and trying to reduce them. And also trying to reduce the new building in high-risk areas. One of the most efficient ways that governments can, over the long term, reduce our exposure to natural disaster risks is to stop people from building in high-risk areas, or ensure that if they do, that they build in ways that are safer and more resilient.
Okay, thank you very much. Over to you, Senator Sharma or Senator McLaughlin.
Thank you, Chair. Thanks, Mr Turner and Mr Stone, for your appearance in your submission today. I just wanted to turn to your comments in your submission on state and territory government levies on insurance. So I think you're right there that state government levies and charges on insurance are inefficient taxes with a relatively high marginal excess burden per dollar of revenue raised. Can you just explain to me a little further that terminology, relatively high marginal excess burden per dollar of revenue raised? What is that, if you could put that in layperson speak, and why is that a bad thing?
So the excess burden of a tax, Senator Sharma, is it's a measure of the loss of welfare for each dollar of revenue earned. It's it's a topic that I'm having difficulty explaining while visualising supply and demand curves in my head.
I think
I think I know what you mean.
It's the sense in which it distorts private decisions. And
Yep.
so, I mean, in a sense, much of the previous discussion we've had is a demonstration of that. If something's price sensitive, if people are price sensitive to a product, and you imposing, a tax on that, and that distorts their decisions in a big way, that's why there's a high marginal burden. It's changing behaviour a lot. It's away from what would be an optimal level, and so I think this connects the discussion we've been having. The reason why levies might be particularly high excess burden is it because it causes too many choices that are poor.
Yeah,
from an individual's point of view, right? That's why it's a high burden. I think it's reasonable to say in a tax economic sense. So, and there's other taxes that distort decisions less, and there's been many reviews on that issue, wider bases, all that sort of stuff is why it can have a lower marginal burden. But the reason stamp duties are often focused on is it actually distorts behaviour so much in all the ways we've been talking about. People underinsure, they will move house less commonly than they should. All those they're very distorting taxes for the very reason we're talking about. People won't make the right decisions because of the tax, and I think that's a reasonable layman's way. It mightn't be technically right, but in most cases I'm pretty sure it would be right, and so it's why this has a high excess burden, is because it changes the behaviours in the way we've been talking.
Yeah, I see. So your recommendation would be to replace it with broader-based taxes, like property taxes, for instance, in less distorting ways.
Would not mention the taxes to go to. That's a big set of questions, and there's several ways of doing it. But I think the point with stamp duty and some of these highly inefficient taxes that almost any other revenue raising, most other revenue raising in the kit bag are more efficient, both open to within jurisdictions, tax bases, and more broadly. So they're particularly inefficient, I think, is where, and it's for all the reasons we've been talking about. that people will underinsure or under-invest in. It'll put too much distortion into day-to-day decisions for the reasons we've talked about.
Yeah, okay, understood. And you mentioned earlier in your submission just the important signalling role that insurance premiums have for households, which will either discourage them from locating in high-risk areas or encourage them to engage in mitigation activities. Do you have any concern that removing taxes and, say, lowering the risk of premiums lessens that signalling mechanism, or because it's a relative?
It brings it closer to what would be the optimal signalling level.
Yes,
at the moment the price is too high. It's distorted, so it would at the margin do that, but I think that would suggest it would be closer to what the right signalling is and would have the positive effects that people have talked about of less people being underinsured, people taking the optimal amount of insurance because they're not paying a distorted price for it. Now, correct me if I'm wrong, Stuart, you've worked on this for a bit longer.
Yeah, okay. No, that's helpful, thank you. And then, look, you also, in your submission, which I found very helpful, you warn about the potential risks for government intervention in the market, and particularly interventions which would distort that price signal by either compelling or forcing some sort of cross-subsidy from lower-risk households to higher-risk households. Can you just explain your policy rationale a little more there?
Yeah, sure. What we were talking about there was a term in the terms of reference about for this inquiry about the allocation of the costs of insurance.
Yeah.
Any hypothetical policy measure that involved essentially increasing insurance premiums for people in low-risk areas in order to reduce them for high-risk areas would have unintended consequence or have negative consequences in two respects. First, people in lower risk areas would be facing higher premiums and they would take out less insurance. Lower risk doesn't mean no risk, so there would then be cases of underinsurance. Mm-hmm. And second, people in high risk areas would be receiving an unrealistic signal of the risks they face through their insurance premiums. If you significantly reduce the cost of insurance in a high risk area, that does blunt the financial incentive that people have to make choices about where to locate, what to build, and whether to stay in an area. So the cross-subsidy would ultimately increase the level of disaster risk that people would be facing in all areas.
Mm. Okay, thank you. And then I just wanted to touch lastly again on taxes. You quote the Henry Review, which is now getting a bit dated, 2010, but that Australia has high taxes on insurance, both in comparison to the taxes imposed on other products and industry, as well as compared to other countries. Is that still a valid comparison? So obviously the Henry Review is from 2010, but is it your understanding that Australia has relatively high taxes on insurance compared to other OECD or advanced economies?
That's my understanding, Senator. I have not looked into the specifics recently, other than to acknowledge that some jurisdictions have, over the past 5 to 10 years, taken steps to reduce and phase out some of these inefficient taxes.
Yep.
So there has been some progress, but some of the, so for example, Queensland, I think, still has duties on insurance which are similar to the level that prevailed in 2014 when we did our report on climate change, on natural disaster funding. Mm-hmm. So I think that still remains broadly the case.
Yeah. Okay.
Irrespective, though, of whether we have high or low taxes by international standards, they remain an inefficient way to raise revenue and have significantly negative consequences for the functioning of the insurance market.
Okay, thank you. Senator Ball. Yep. That was all I had. Thank you to both. Thank you, Chair.
Do you have any further questions, Senator Sheldon?
No,
Great. Well, thank you very much both for being here and responding to our questions.
Thank you.
Thank you.
Do we have them? Okay, great. Thank you. I now welcome Professor Jas Abkowski, Dr. Settle, and Mr. Gottschalk via teleconference, and Mr. Rod Campbell in person. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will each of you please state your full name and the capacity in which you appear today? And I might start with Mr. Campbell.
My name is Rod Campbell. I'm the Research Director at the Australia Institute.
Thank you. If I could go to Mr. Gottschalk next.
Hello, my name is Adam Gottschalk. I'm an Anne Cantor Fellow at the Australia Institute.
Thank you. And Professor Jas Abkowski.
I'm Paula Jas-Abkowski and I'm a Professor of Strategic Management at the University of Queensland.
And Dr. Settle.
Hi, my name is Dr. Antonia Settle. I'm a lecturer at Monash University.
Thank you very much. And I now invite you to make a short opening statement. And I might start with you, Mr. Campbell.
Mr. Gottschalk has our opening statement.
Okay, great. Over to you, Mr. Gottschalk.
Thank you very much, and thank you very much for the committee for the opportunity to appear today to talk about two of Australia's biggest issues, cost of living and climate change, and the way that they are linked together. So while climate change is affecting costs in many different ways, increased insurance costs is one of the clearest examples of this. So to take you through a few key points, insured catastrophe losses reached a record $7 billion in 2022, driven by the Eastern Australian floods. And since 2013, insured losses in each year have exceeded the combined losses of the 5 years from 2000 to 2004. Between 2022 and 2023, the average home insurance premium in Australia rose by 14%, which is the biggest rise in a decade. And these increases to insurance premiums are outpacing inflation. Over the past 35 years, insurance costs in every single capital city have vastly exceeded consumer price index increases. In Brisbane, they rose by more than 5 times the CPI. And in Melbourne, where the increase was lowest, it was still 2.7 times the CPI. So these costs are not shared equally across the country. They fall disproportionately on people on low incomes. Nearly 1 in 8 households, which is 1.25 million households, suffer home insurance affordability stress, and they pay more than 4 weeks gross income on home insurance premiums. 1 in 20 pay more than 7 weeks gross income on home insurance. So another way of thinking about this is that over 1 million Australian households effectively have to work from New Year's Day to the end of January just to pay their home insurance fees. The burden of rising insurance premiums also falls unequally across different parts of the country, and it especially affects people living in Northern Australia. So home and contents insurance in Northern WA costs more than double that in the southern two-thirds of Australia. In Northern WA, it costs on average $4,395 a year, and in the southern two-thirds of the country, it costs on average $1,779. That $4,395 is also significantly more than the $3,069, which the average household spends on electricity each year. Household premiums in the NT in Northern Queensland also cost 60% more than those in Southern Australia. So what this means is that global heating and more frequent natural disasters will make whole suburbs or towns uninsurable. Australians are also aware of the way that climate change is increasing insurance in these ways. The Australia Institute's Climate of the Nation report in 2023, which surveys Australians nationwide about climate change, found that 3 in 4 Australians are concerned that climate change will result in more expensive insurance premiums, and 3 in 10 Australians think it is already causing more expensive insurance premiums. The 2024 version of this report is going to be published in the coming weeks, and we will be very happy to provide it to the Secretariat when it is completed. Thank you very much.
Thank you, Mr. Gottschalk. If I could go to Dr. Settle next.
Yep, absolutely. Thank you. I'm very pleased to be here, and Thanks for inviting me. So there's 2 points that I'd like to raise, which emerge out of my research report for Financial Counselling Victoria called Unsettled: Climate Risk and Cash Settlements in Home Insurance. One of the issues that I want to raise related to this report is the issue of cash settlements itself. So that's when the insurer settles a claim with cash instead of the insurer taking responsibility for completing repairs themselves. The reason that the Unsettled report was commissioned by Financial Counselling Victoria was that financial counsellors were reporting that cash settlements were the single biggest problem in insurance for the flood-impacted households that they were working with following the 2022 Victorian floods. The Unsettled report firmly grounds the problem of cash settlements in the pressures that climate change is putting on the insurance system. In short, when something goes wrong with a claim, the claim generally ends up getting cash settled, and climate change is stretching the insurance system, so more things are going wrong with claims. In part, that's about the capacity of the insurance system to deliver in a disaster context, and in part, that's about underinsurance. So people having a sum insured that's not high enough or having patchy coverage with lots of exemptions. But the outcome, through any number of different avenues related to climate change pressures on the system, is that claims end up getting cash settled. And the problem with cash settlements is that households tend to come out of it poorly. The issue is one of information asymmetry. Information asymmetry is just too big for households to be able to negotiate a fair settlement independently. They don't know enough about rebuilding. They don't know enough about the insurance contract to be able to advocate for themselves effectively. So the first point that I want to make today is that cash settlements are a key piece of the climate insurance puzzle. Cash settlements are very damaging because they drive poor material outcomes for households and because they undermine trust in the system. And I'd like to draw your attention to the Unsettled report, which provides concrete policy proposals for addressing the problem that cash settlements pose. That report also spells out the problems that households face in relation to cash settlements, the way that cash settlements emerge as a friction in the insurance system under the weight of climate change. The second issue that I'd like to raise is about the problem of improving resilience in the housing stock and the hindrance that insurance plays at the moment in making those improvements. The issue here is that insurers not only fail to support households to build back better during a claim, but they actively discourage households from building back better. Because insurance contracts entail like-for-like reinstatement that deliberately excludes betterment from rebuilds, households can't, for example, use flood-resilient materials in their insurer rebuild or strengthen efficiency measures beyond the bare minimum of building standards. They can't build back better. They can't make those improvements unless they want to cash settle. And as I've suggested, it's pretty much never advisable to cash settle unless you're a builder yourself. Policymakers need to make meaningful change here because change is not coming spontaneously from the sector. The failure of the industry to support building back better, despite all the fantastic climate advocacy that the sector has been doing for a number of years, to me, this is clear and hard evidence that the sector is not delivering the dynamism that we expect from private markets. The sector is calling out to be much more heavily regulated. Persisting with like-for-like reinstatement by offering practically no product innovation this far into the climate crisis is really very poor performance. And this, I think we need to understand this as a domain of public policy that needs proper regulation. It needs to be understood as public policy. It doesn't need competition policy. The Unsettled report includes some recommendations on this set of issues. So getting rid of like-for-like reinstatement and allowing flexibility in how households use the insurer indemnity to rebuild is a key recommendation. So allowing households to replace, say, a large home with a smaller, higher quality home that has resilience and efficiency built in. Training loss assessors is another policy proposals from the report. So training loss assessors in resilience and in efficiency so that loss assessors can advise on resilience and efficiency improvement as part of the scope of works. Also implementing a flood re-style grant for improvement, so flood re being the UK pool. We need to be very clear though, I think that a flood re-style bonus in itself is nowhere near enough of a reform. The flood re-grant, it's easy and it won't face resistance from the industry, but it's not the main game here. Legislative change is really required because we need to put betterment into the heart of the contract, not betterment as in a jacuzzi on the balcony, but betterment as in resilience and efficiency standards that help insurance to contribute on this major public policy issue, which is about improving the housing stock. I'm running out of time here, so I'm going to stop just in just a moment. But I also want to point out the building standards need to improve. And you know, what we're talking about here is homes that have realised disaster risk. So we can bypass the messy politics of increasing building standards, which is, you know, proving ineffective. We can do that with a much more targeted measure by making insurance companies deliver resilience and efficiency in those insurer rebuilds. Thank you very much.
Thank you very much, Dr. Settle. Could I go to Professor Jarzabkowski?
Yes, certainly. Thanks very much for inviting me to speak. I'm going to speak from the basis of my research in both Australia and world, being the reinsurance sector and disaster insurance pools since for the last 20 years. What I'd like to say is that what is happening in Australia in terms of insurance is a combination of increasingly extreme and certainly extreme and also increasingly frequent weather events, but also in relation to the legacy assets that we already have. So we have vulnerabilities because we have already built and the types of housing stock that we have. In addition to that, we are probably also doing new building in places that are already known to be weather exposed and uninsurable. So we've got this combination of factors in which it's increasing urbanisation, the nature of the assets already in the path of this weather, and then the weather itself getting worse. I think it's worth pointing, I'm sure you've heard about this many times, and already our first speaker also referred to it, that the extent to which Australians are facing extreme insurance affordability stress is increasing rapidly. So an Institute of Actuaries report found that in 2022, 10% of Australian households faced extreme insurance stress. By 2023, it was 12%, and the latest report only recently out shows that that's already 15%. So we can say that this is increasing very rapidly in terms of the problem that we're facing. I'd like to point out from my research around the world that this is not a problem that will self-correct in Australia, because the way that the dynamics of the insurance and reinsurance market work show that this is a problem worldwide. So we're seeing similar sorts of problems in the US. For example, 60% of some states like Louisiana are uninsurable or facing unaffordable insurance. So we need to accept that this is not simply a market failure, simply a self-correcting market problem. This is more, we are at a tipping point in major change worldwide. Now, one of the things that is often posed as the counteract to high premiums is risk mitigation, that if somebody would mitigate the risk, then the premiums would go down. However, the link between risk mitigation and premium reduction is actually very weak. If we keep in mind that insurance is an individual product for an individual house, there's often very little that an individual can do to their house that will clearly lead to a substantive reduction in the premium offered to them on that house. So that in itself is problematic, but also some of the mitigations that are required are not within people's capability to do. So, for example, infrastructure, changing, the dams and the way that water is released and so forth are simply not within the capability of people. So to say to them that that is a way to reduce their premiums is somewhat meaningless. There are ways to keep people insured, even under these sorts of conditions, and I actually have written a book about that and looking at 17 risk pools operating in 49 countries around the world. These are various forms of government legislated insurance and reinsurance pools for all kinds of hazard, but particularly let me refer to those that deal with so-called natural hazards, so things like flood, tropical storm, earthquake, and sort of things like avalanche and fire. So these are pools in which normally the way that they work is some form of redistribution across the economy. So everybody who is insured, and the flood example that you've heard referred to, is everybody that is insured pays a small levy from their insurance into a government-based pool. Sometimes that government-based pool also has a government backstop, so that the government is generating a backstop, its only insurance pool, in order to lower the price for those at higher risk. There are various ways of doing this, and I don't want to get into a lot of detail about how. I'm very happy to provide a report on that to the committee. But what I want to say is that one of the things you will hear often criticised about these risk pools is that they are a moral hazard, that they just allow people who are at high risk to remain where they are and to keep building in high-risk zones. While that is certainly true of some poorly designed types of government-legislated insurance schemes, such as what has happened in the US with the National Flood Insurance Program, that is not automatically a feature of pools. It's to do with their design. And so well-designed ones, and the best designed one that I know of is in Switzerland, are ones that then use this situation to keep prices down, but then because they are fully integrated into the government resilience ecosystem, also shape construction codes, disaster risk mitigation, flood maps and other types of hazard maps, and so help to fuel a system in which the risk is reduced across society. Naturally, in any country, even if you do have a risk pool, you are still facing climate change. But what a risk pool does do is give a lot of publicly owned knowledge about where is the risk, what are the claims, who are vulnerable, and how might we use that knowledge to zone how the types of housing will do, the types of building construction that will do. So while I would see that pools are not a full solution to the problem we have in Australia, they are part of the solution, but only if well designed to support a better resilience ecosystem. And I'll stop there now, hopefully having given some thoughts about where my knowledge can lie in relation to the Select Committee.
Thank you very much, Professor Jarzabkowski. If I could start with a couple of questions for you. Do you see any end in sight of these pretty massive, spiky increases in insurance premiums for people, given the escalating frequency and severity of climate-driven natural disasters? I mean, I'm asking, is this going to be how it is from now, or do you expect prices to moderate somehow?
I'm sorry, I didn't hear who the question was addressed to.
So I guess the question is that do you see any change happening in how the price of premiums, insurance premiums, has been rising pretty massively and in huge spikes? Do you see any change will happen there soon, or do you think, will these moderate, or do you think this is the way it's going to be?
I do not think that. You might get some small fluctuations according to the cost of global capital in the reinsurance market, but the main problem is that the way that the market functions in relation to disaster means that prices go up, the more losses there are, and the cost of capital goes up. So this will, my view of this is that this will not self-correct. It will continue to get higher.
And you've written in your submission or in various reports, and you've also mentioned it in your opening statement, about how government owning the risk pool of insurance has to be coupled with risk reduction. And I know you've highlighted a few of those risk reduction areas. But can you do you have a hierarchy of risk reduction that you've looked into? What would be the top on your list of risk reduction, for instance?
So the very first thing would be the point of each time that a claim is paid, it is used to build back better. So that would be the very first thing. That in itself won't bring about the systemic change, but it is nonetheless, because the claim would be being paid via the government-based insurer or supported between the government-based insurer and the private insurer, like flood-re, you can build in a build back better element in which claims are used to make individual houses more resilient. Beyond that, what would be needed is some form of using claims knowledge to enter into a zoning type of understanding of what is the risk to these types of houses, and therefore what is our longer term plan for those houses. Because once you build up a body of claims knowledge, alongside a body of knowledge about the structural stock, because that's what you get when you have claims and you pay them, then you could start saying, how do we want to zone these areas that suffer frequent or repeated claims? And that might be, then part of a government policy to look at over a certain period of time, these are the most eligible for buyback, those are the most eligible for certain other kinds of mitigation measures, depending on the presenting combination of hazards, which could be cyclone, flood, or bushfire, most likely here. Beyond that, the knowledge should always go into updating the hazard maps, because every time that you get a loss, you have another data point, and that could go into updating the hazard maps that are used for planning and new build. That would need to be the next thing. But all of these things would probably happen together. And then I guess that would also go into building and construction codes. So that would be the sort of 4 key areas that I would see are major leverage points.
Many submissions point to addressing the heart of the problem, which is the climate crisis itself. Would you have a view on that, Professor?
Obviously, we should do all we can to address the climate crisis in terms of, preventing further warming and preventing, further input into extreme weather. But even if we were to do that instantly, some of what we have done is already there, because we can't reverse what we have done at any speed. And we also, as I pointed out, have these legacy assets and the way that we have built, which exacerbates things like flash flooding, urban flooding, and so forth. So I believe that we definitely need to try and stop the climate crisis, but that in itself won't be sufficient to change the problem that we're facing. We then still would need to do adaptation to what we already have.
Of course, the people who are on the front lines of the climate crisis facing, floods and other disasters, climate-driven disasters, are being damaged and impacted the most. But the more this inquiry goes on, the more it feels like the insurance industry itself is going to be the first to be turned upside down from, I guess, what I say, rising coal and gas emissions. And this is a question to anyone who wants to respond. Would you agree that there is a real risk that the insurance company industry itself goes down? Maybe I'll start with you, Professor.
I can say something if no one else wants to step in there. I think that there's obviously a lot of pressure on the system, on private insurers, and whether they go down or not, whether insurers collapse, I think there's probably a bit more nuance going on there. And I think the issue is more about their markets shrinking and them relying ever more on state subsidies. So I think there's a real risk, and we can see that the sector has been quite urgent in its advocacy. But as I pointed out in my opening statement, I think there's also been not so much action coming from the sector in terms of what it could be actually doing to address these issues. But obviously the sector is pretty concerned about how things are going, because they're losing a lot of customers. Thank you.
Thank you, Professor. And if I could go to the Australia Institute, in your report, Premium Price, you have said rising insurance premiums are the here and now cost of climate change. And, a few places around the world, and the US state of Vermont is one of those, recently introduced laws to make big fossil fuel companies pay for the damage of weather disasters fueled by climate change. Is that, and obviously from where I sit, this is the polluter pays principle. I just wanted to get your view on, is that something we should be doing here, but not just paying for the cost of disasters, but also the cost of insurance maybe, or reinsurance? Would love to hear your thoughts if you have a view on that.
Yeah, absolutely. Pardon me. And we're happy to table that report if that's of use to the committee.
Would the committee agree to tabling that report? It's a report
The one attached. Oh, yeah.
Yes.
Yeah, that's fine.
Yes, thank you.
Great. The Australia Institute's proposed for quite some time now a fossil fuel export levy of $1 per tonne of embodied climate pollution, and that would raise around $1.5 billion per year. Our argument has been that money should be directed towards the costs of climate change from which fossil fuel companies are profiting. And I think a very useful use of some of that money would be towards addressing some of these insurance issues.
Just in terms of the like for like, if I could go to you, Dr. Settle, you were talking about people being allowed to changing, standards and regulations for people to build homes that are more resilient than what they were before a natural disaster hit. Would that be a recommendation that you would make to this committee to make changes for them to be able to do that?
Yeah, absolutely. And I've made it, as I mentioned, this report that I wrote for Financial Counselling Victoria, the Unsettled report, that has a series of recommendations, and I think that recommendation about getting rid of like-for-like reinstatement and building betterment into the contract, which requires legislative change. I mean, that is a reorientation of the sector, because the whole point of insurance as it stands, as it exists presently, is that insurers won't pay for betterment. They won't pay for you to improve your home or even kind of accommodate that within a rebuild. But we need to shift that around, because improving the housing stock in terms of efficiency as well as resilience is a really important public policy goal in this country at the moment. So I think that dealing with efficiency, adding efficiency as well as resilience into those improvements, in getting rid of like-for-like, that's important, and that's important for the sector to take some responsibility around the climate challenge. Building resilience into new stock, rebuilding homes with the same risk is a kind of madness. It seems crazy that this is how insurance works at the moment. So I think that's a very important first step.
Thank you. And my last question before I hand over to others, and I can come back if there is time at the end, just to the Australia Institute, what do you see if things keep going like they are? What do you think is the worst case scenario?
Regarding insurance in
Australia? Insurance or climate?
Yeah. I think coming back on a question I think you asked a little bit earlier, perhaps a useful comparison is the private health insurance industry, which is continually about to collapse and continually pushing government for further and further assistance. And I wonder if that's where we would see house and contents insurance going as well. It's clearly something that is very important to people's lives. We can't do without it in some form, but without some kind of clear policy direction, do we end up with home and house insurance essentially being like the private health insurance industry, of continually leaning on government and requiring different kinds of either direct subsidies, reinsurance funds, or other kinds of policy assistance? That seems to be a possible outcome as far as I can see.
And just really quickly on climate, I completely agree with Professor Jazepskowski that obviously climate change is happening and we need to adapt and we need to put more effort into adaptation and resilience. But we still need to address to stop the worst case scenario from happening. And does that include more serious action on ending fossil fuel extraction and burning? And what's for you, what are the top kind of things that we have to, initiate right now to make sure that there is some semblance of a future for people in the next 50 years?
Yeah, absolutely. I think that's the underlying question, really. The Australian government should immediately end fossil fuel subsidies. All Australian governments subsidised major fossil fuel users and producers to the tune of $14.5 billion last year. If that was eliminated each year, you'd see suddenly a large amount of money that could be directed towards climate adaptation, insurance and other services that the Australian community really needs. So ending fossil fuel subsidies, ending new coal and gas projects, I mean, it was very concerning to see new coal projects approved just last week that were really quite large. They were even quite dirty and thermal coal projects at that. So they were some of the worst kinds of fossil fuel projects that we could be approving just last week. So ending fossil fuel subsidies and ending new fossil fuel projects, I think, would be the immediate things that Australian governments should be doing in terms of mitigation and addressing the climate crisis in general. And obviously we can talk a lot more about insurance and housing, etc.
Yeah. Thank you very much. Senator Sheldon.
Good, thanks. But I just want to go to, again, back to this question of insurance prices, and some of you may have heard this in earlier evidence, but the brokers and insurers claim that high commissions are justified as they provide customers with risk advice. But I just want to go to just wondering how that can be defended when these commissions reach outrageous levels of 40%, leaving homeowners out of pocket. It does seem to be profiteering disguised as advice. Mr. Campbell, do you have any observations on those sorts of figures?
Regarding those figures, I'd have to take that on notice. It might be a question better for Dr. Settle and Professor Jakowski.
Dr. Settle, have you got any observations on this question of very high, exorbitant brokers' fees and justifying it as risk advice rather than just extortion?
I don't have any comments on that at this moment, I think. Professor Dabakowski?
Yeah, I'm unfamiliar with what the broker commission is on a premium price, so it would be difficult for me to comment that knowledgeably.
Well, I might just go then to another question. Just I understand that the question of the holistic approach, weighs heavily on the committee as well, and our deliberations and many witnesses so far. And everyone's gone through a number of steps that need to be taken and will continue to be taken or realised to take pressure off both insurance prices and also the community more generally to make it more resilient. I just want to go to one particular matter, and that's regarding the merits of the government-backed reinsurance pools. Just want to be clear from everyone what their views are about the North Queensland scheme, and separately about the merits of such schemes supporting other areas where insurance is particularly unaffordable. Let's go with Mr. Campbell, he's here.
I'm happy to start just because I'm in the room.
Yep.
Yeah, I think this is an area that will need careful consideration, because I think it was the view of an ACCC review of that pool was that it's really hard to see. The ACCC said it will be some time before the full effects of changes to prices and choice are seen across the industry, and it may be difficult to isolate the effects of the pool from the range of other factors impacting insurance markets. So I think it's really important to be careful that we're not just providing a straight subsidy for insurance companies and actually doing something to address the underlying issues.
Dr. Settle?
Yep, thank you. Look, I find it difficult to understand how the pool will deliver a lot of benefits to households insofar as it's cost neutral. So what's only being taken out of a pre-pool arrangement that uses the private market is that margin of profit that a private reinsurer would take. So I find it difficult to be able to appreciate how that pool is going to deliver real savings. I think that Paula's point earlier that the value of a pool is in information, in data. That data already exists, and the insurance sector has data but public policy doesn't necessarily have access to that data. So having the pool generate all sorts of interesting information about where risks are being realised and where insurance is actually being drawn upon to do what, that is what is, I can see the value there, and I think that's a really valuable point, that if we are going to use public policy to address the impacts of climate change on households, which is playing out through insurance, then we need to know what's going on. And we don't know a lot of what's going on, and insurance data is an excellent tool for doing that. So I think there is value there. The other thing I'd like to say about the reinsurance pool is that there's no risk mitigation. I know there is a facility for risk pricing premiums, so using the pool to provide discounts to households for household level mitigation. But as I understand, that facility has not been used. And so the pool itself, the problem of climate risk is what's driving premiums up. The pool doesn't address the problem of the risk and the fact that the risk is growing. So to me, the pool is useful for its information, useful potentially for bringing premiums down in kind of small ways, but what we really need to do is address the risk. Thanks.
And Professor Jakowski?
Yeah, so look, the cyclone insurance pool has potentially, because it is a piece of legislation which has shown that the government can and will make some effort to intervene where the market isn't working for a bunch of consumers. In its current format, it would not be enough to fix the problem. That said, once you have some legislation, you already have shown a willingness to start having that set of changes. So from my perspective, you can't, it's brought some savings, it's increased, but it's brought some premiums down, it's increased some availability in that area. It doesn't have the clear links between risk mitigation, and the risk mitigation is something that can be done by the insurer, or the premium reduction can be done by the insurer. It's not something that's a function of the pool. The problem with the pool that we currently have is if you actually want to fix the insurance problem in Australia, you have to go much further than what the cyclone pool has done. So when you ask me how do I feel about the cyclone pool, I think it's a step in the right direction, but on its own, it is cost neutral, it's not cross-subsidising, and it is one of the other things. I mean, there are two things that really make a big difference. One is cross-subsidy and the other is mandatory. And where you see the most effect for any kind of government pooling in both reducing premiums but also then being able to use data systemically to address individual households and their risk is where you have a mandatory pool. We see that in Switzerland, New Zealand, France and Spain, and where you operate a cross-subsidisation model based on that. And then that cross-subsidisation is, and that data is also used to start managing the risk down and changing the zoning. Australia is certainly, with its cyclone pool, nowhere near that yet, but I remain optimistic that if we actually want to keep people insured, as opposed to some other form of disaster fund, that we have at least shown through the cyclone pool a willingness to try to engage with the issue.
Thank you. This question about mitigation and resilience, and particularly, keeping on the subject of homes in particular. I'm sure many of you are aware of the Queensland Housing Resilience Program, which is where homeowners had resilience works approved have reported an average insurance premium saving of 9%, which is part of a program that you're aware that the Commonwealth and Queensland governments are applying, largely in North Queensland. And the Queensland Resilient Homes Fund in Southeast Queensland, again, have very similar arrangements, but includes buybacks as well as upgrading homes to make them more resilient. And of course, there's programs in far northern New South Wales. What's your view about those schemes, but also what's your view about those schemes and their relevance to being expanded elsewhere, and the importance or otherwise of them?
I'm happy to jump in on that because my team and I are currently conducting the evaluation of the Queensland Reconstruction Authority Resilient Homes Fund, which is the buyback, retrofit and raising, as well as the industry and community engagement and the flood maps. We're funded by the Natural Hazards Research Australia and the Queensland Reconstruction Authority to do that piece of work. As part of that, I would say that this rolling out policies like this is complex because the policy itself is a very good concept, but it's rolling out to individuals who have been traumatised post-flood. So one of the things that we need to accept is that it will take time to get the level of change that is needed across a substantive amount of housing stock. Nonetheless, it's a step in the right direction. At this stage, there is no clarity about whether that will change premium pricing, for example, a retrofit or a raising. There is no clear one-to-one correspondence. In fact, there's not a lot of evidence of that. I know Suncorp did a little with their Resilient Road. I'm familiar with the Flood Resilient Homes program that Brisbane did as a pilot, but the reports on the changes in insurance are self-reports and they're not a systematic study. So we can't be clear that doing those things has definitely changed flood insurance premiums for those people. This is only a flood program. So I think it's very important that we do roll out more of these resilient homes funds. What's absolutely critical is that we collect the data on them as well. What happens to the homes that are being done? Because then we can use that as evidence to go forward into, at the moment we're not doing it on a zoning basis, we're doing it on a house-by-house basis. We could then use some of that information next time we have a flood, which we definitely will have, in order to say which houses fared in what way. We could look at things like home buyback. Part of this, as a current home buyback, you can see places where there's already been previous buyback and we're now getting significant tracts of land, which could be repurposed for nature-based solutions or other types of flood-based infrastructure. But we still have also lots of little patches, so we could start to understand, okay, what happens with buyback? How does that change water flows? Should we start to zone areas for long-term buyback rather than saying there's a ceiling to buyback or a time at which buyback should finish because the fund or something has finished, but to say if it was ever eligible for buyback, then at some stage it should always be eligible for buyback, even if this current homeowner is not in a position to move. So I think we're in a really interesting and important space with these programs rolling out in Queensland and now starting to roll out in New South Wales, where we have an opportunity to both create change but also learn from the very incremental nature of the change that we're doing.
Thank you for that, Dr. Settle. Is there any other observations that any of the other panellists would like to make comment?
That was Paula Jalzakowski, not Antonio Settle.
Thank you. We had motorbikes in the background here, so I wasn't quite sure. Thank you for that. Good, thanks. Just time for one more.
Yes.
Just with respect to mitigation investments, and whether it's made by a property owner or a council. During the hearing, we've heard insurers are often quick to respond to risk by raising premiums, but are far slower in reducing premiums when mitigation investments are made. Or in some cases, they just raise premiums regardless. Some of the observations, some of the evidence we've received. Have any of you explored this issue at all? And if so, what should we be doing about it?
We haven't, so I'll pass that on.
Dr. Settle?
Look, there is certainly some kind of arguments for having a price regulator that regulates insurance around mitigation, so implementing a regulatory regime that requires, mitigation discounts. And the idea is that if that is done, then we need potentially a new regulator that's not, say, the ACCC, but a more specific regulator that can be tracking those changes, because it seems like it's not something. I think there has been some movements within the sector to try and look at this, but it's not something that's moving very quickly. So what I'm saying is the sector itself is not kind of going to drive mitigation discounts. So I think that, like so many things in this area, it's something that needs to come from the regulator's side. to push the sector to make some changes. But yeah, how that's tracked and maintained, is another question. I suppose that certainly considering having a specific regulator that ensures that mitigation discounts are being delivered might be something worth considering. Thank you.
Thank you. Professor Jaskowski, did you have a view on that matter?
Yes, so the reason that premiums go up, you'll often see that premiums have gone up in areas adjacent to where losses have happened, even for those, for example, with floods, you say, look, I'm on the hill. If this place floods, everywhere's going, is to understand how insurance works with reinsurance. And I mean, I've literally sat in meetings between insurers and their reinsurers when they're discussing the risk profile. And what an insurer will show a reinsurer as part of getting a more competitive price on their reinsurance is how they are moving risk out of problematic zones. So, we need to accept that while insurer could be quite granular, when they want to buy their reinsurance, which is how they make sure they have enough for big losses, they also need to show that they are moving out of a zone that is at high risk. And so from a reinsurer's perspective, a whole suburb or a whole postcode may be high risk zone, even so that some houses within that aren't. So this again is where using data and potentially a state-based pool or something like that is that they can account for and back themselves about which houses are higher and lower risk, because they have to take the risk, they have to pay the claims. Whereas the insurer is actually doing some form of passing that off to the reinsurer, who's going to provide a better price if they can show a better zone. So that's one way that markets work, and it is, it's not a blame thing here. That's what the market is. That's how capital is costed. So I think that is one of the issues that you'll see where people's prices go up generally. The other thing is that insurance, even in the private sector, is a pooling mechanism. The more claims that are paid, the more that everybody's premium goes up as part of the overall cost of insurance. So that's a second thing. And I guess this is that, the third thing is this is the space in which well-designed government intervention that collaborates with and supports, encourages, motivates, incentivizes the private sector to start taking a clear share in the role of pricing and risk reduction, then, that is where it's necessary. It's probably to occur without that legislation.
Good, thank you for that. Back to you, Chair.
Thank you, Senator Sheldon. Senator McLaughlin.
Yes, Professor, during your opening statement you made mention that you were happy to provide certain further materials. Can I just encourage you to do so? You will see at certain points when you look at your Hansard, but I don't wish to sort of explore that now. I'd be interested in doing further reading, and if there's any other public papers you can provide on the matters you raised in your academic research, I would appreciate it if you could send to the Secretariat. I just
certainly happy to do that.
Yeah, thank you. I just want to go to the Australia Institute. Have you formed a view on the role of local government in the matters that you've raised in your paper?
Only that local government ends up bearing a lot of the costs, but obviously has very little capacity to raise funds for the costs that climate change is imposing upon it.
Why do you say it's very little opportunity? I mean, local government in some states like mine, South Australian, can borrow and they can raise rates. I'm just trying to understand why you feel they're limited in that regard. They may be politically limited, but I'm really asking in a technical sense.
I mean, I think...
some states that might be true, depending on what the legislative...
Yeah, and I haven't done any research on the varying capacities of local governments to raise income, but in Australia it's fairly widely accepted that the Commonwealth raises the money and the states and to some extent local government spend the money, and that seems to be fairly clearly the case here.
They're also making the decision on where developments take place. So from a regulatory perspective, have you formed a view on the impacts of their decision making into the overall marketplace?
Look, we haven't done recent research on this, no.
Can I just, on another issue, so let's just segue. I just want to take you to your conclusion in your paper, which we have. And you talk about the government's reinsurance scheme only had a modest effect because it subsidises insurance but does not directly assist homeowners. Can you just sort of unpack that for me? I'm just trying to understand it. I'm not coming from a question of challenge. You do add a sentence, those already priced out of the market or unable to access insurance are not assisted at all. So I'm interested in how you've quantified the sort of modest effect and what that really means.
Yeah, I think we're really relying on the ACCC's assessment there. We haven't conducted our own assessment.
Yeah, I'm not trying to challenge, I'm just trying to join the dots.
Yeah,
the benefit of trying to understand your report. You made the comment, I think, in your opening, and I think you make it in your paper, that obviously people were paying more in different areas depending on where they live. There's an argument that's been put to us, though, if you take away the moral hazard, people will continue, leave aside people already in the market, but people who are thinking of entering into the housing market will make decisions regardless of the impacts of climate change. Do you have a view on that? Because you could say that if you price correctly, it will encourage people not, or the industry or the developers, to take those parts of Australia that haven't been affected by industrialisation, for example, areas of nature that haven't been exploited as yet. Probably a very convoluted question, but I'm trying to understand the argument that if you take the argument that if you socialise the costs, or a person's paying the same insurance in northern Queensland as they are in South Australia, you're also then taking away moral hazard and encourages them to live in places that may put at risk development of the natural environment. Do you have a view on that, or the economics of that?
Yeah, I guess stepping back from the economics of it, we don't want people to be making decisions in Australia about where they live purely on insurance premiums or even purely on price. You know, we want people to be able to keep living in the communities that they live in, that they want to live in. By the same token, I don't think we don't want to encourage people to live in problematic locations with problematic and risky kinds of housing. So I think the solution lies somewhere in the middle.
Okay, that's all I have. Thank you, Chair.
Okay, I have a couple more questions. That's okay. First one to you, Professor Jazabkowski. You have written about how cyclone-exposed Northern Australia is already seeing the impacts of course, insurance unavailability and affordability, that tourism and hospitality owners are facing massive struggles to keep their businesses going. Could you tell us a little bit about that? And do you think the same thing, if you've looked at it, is happening now with flooding and climate-driven flooding disasters?
So wherever you have a loss of ability to insure, you will see a disproportionate effect on small businesses, particularly small and medium-sized enterprises, as well as households, because they need insurance as part of their ability to continue to get credit. And obviously credit is, mortgages, lending are key features of the way that our economy works. So what you're seeing anywhere, what you see in Northern Australia, repeated disasters, no insurance to rebuild afterwards, and not having insurance as a guarantee against assets going forward is definitely problematic, and you will see that in other places that are facing flood. In fact, we see that, while there haven't been strong systematic reports I'm aware of in Australia, although that work could have been done and I'm simply unaware of it, that the Federal Emergency Management Agency in the US found that 25% of small businesses never come back after disaster. At least some of that will be related to the fact that they don't have the financial wherewithal. So we can certainly say that insurance is both a problem for reconstruction after disaster, but lack of insurance is also a problem for future growth because of the ability to access other things like lending. If you don't have insurance, you can't access those things. So it's both affecting your recovery, but it's also affecting your ability to continue to grow or to thrive. And that is one of my concerns when we move into, as we are now, a significant percentage of Australia being underinsured or uninsured, that we are driving inequality, we're hollowing out communities from the small businesses and things that makes them into communities beyond just the households.
Mm-hmm. And is that something, this is to you, Mr. Campbell, you, in the report that I mentioned earlier, the premium price report, there's a section on insurance and inequity. Is that kind of the inequity you were looking into as well?
Yeah, absolutely. I mean, that is what we found, that some of the poorer lower income households tend to be facing the more rapid increases in insurance premiums. Yeah.
Mm-hmm. And is that because they are also on the front lines of climate change?
Yeah, absolutely.
Yeah. And just my last question for you, because I just want to clarify on the cyclone reinsurance pool. From what I could understand was, and especially from Professor Jaz Epkowski and also from Dr. Settle, that this pool you thought was making some difference in terms of lowering premiums, but that it needed to be expanded to do other things. Am I correct in that assumption?
I'm happy to go first, Antonia.
Please.
Yes. So the thing is, for a start, it's monohazard. That's always more of a problem than multi-hazard because it doesn't get the diversification of risk across the population. So that's one of the issues. Ideally, multiple hazards that face Australia would be dealt with in the one pool, and that gets you diversification and cross-subsidisation. Secondly, it is intended to be cost neutral, so that makes it, and it is not compulsory. So in that sense, it will also struggle to get a big enough pool of parties involved in order to subsidise to reduce risk. And it doesn't have a direct link to risk mitigation, although it does say that incentives can be offered through premiums, but there's no direct link. If those three things could be addressed, then I think that would greatly expand the potential of that or any kind of insurance-based risk pool in Australia to help with the crisis that we are facing. So it's not enough on its own, but certain specific ways of redesigning to expand its remit would make it more capable of doing the job we need.
Yeah, and redesigning it to expand its remit.
And I'll just jump in to say I agree with everything that Professor Jabakowski has just said, although in addition, her earlier comments about the information, which I referred to earlier as well, the capacity of the pool to collect data on what's happening on the ground is also an important part of it. But yeah, alone it's certainly not going to be, I mean, yeah, it's something to build on, but it's certainly no solution by itself.
Yeah.
Thank you.
Yeah, understood. But redesigning it to increase expand its remit, do you think should also include covering, because at the moment it only covers cyclones, would that include covering floods as well?
I would have thought so, yes.
Yeah.
Yes, and also building in those kind of issues around risk reduction and, mitigation discounts. I mean, I think that once you have that structure, there's ways that you can deliver, it's a way of regulating the product, which opens up some possibilities, I think. Professor Jabakowski, I don't know if you'd like to add something.
Yeah, I think is when a multi-hazard, that means that it would have cyclone, it would have flood. Flood is the presenting problem at the moment. It may be that you also wish to include bushfire. At the moment, we're not in a bushfire season, but it may be that that's something we'll also want to include. That would expand the diversification and the subsidisation capability, but then the absolutely critical thing is seeing it not simply as a tool to keep prices down, because prices can't be kept down without some other significant changes, seeing it as a tool to intervene in resilience and climate adaptation for Australia.
Thank you very much all. Really appreciate your time and responding to our questions. The committee will now suspend for a short break and resume at 1:15 p.m.
Thank you.
Okay, I now welcome Ms. Lucy Mann from 350 Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees have been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Great, thank you. My full name is Lucy Mann and I'm the Chief Executive Officer of 350 Australia.
Thank you, Ms. Mann. I now welcome you to make an opening statement before I invite members to ask questions.
Well, thank you very much for the opportunity to appear today at this important inquiry. 350 Australia is a grassroots climate justice organisation. We have 60,000 members across the continent, and our charitable purpose is to inform and educate the public about climate change, its impact on the natural environment, and also the need to reduce fossil fuel emissions and adopt renewable energy solutions. So today I'd particularly like to speak to the question of the redistribution of the cost of climate disasters across the economy, and I'll also quickly address the need for significantly increased government funding for both adaptation as well as loss and damage. So relying on individuals and businesses to take out insurance to cover the cost of climate disasters is not a just or an equitable approach. Already we know that some households can't afford insurance. This is really approaching a crisis situation in Australia with escalating climate disasters, and according to the Climate Council, 1 in 25 households will be uninsurable by 2030, and 1 in 11 are at risk of being underinsured by then, and that's due to the skyrocketing premiums as well as the expected escalating climate disasters. The number of households who can't insure is just going to increase, and insurance is going to become less affordable, and a person's ability to pay for higher and higher insurance premiums really shouldn't determine whether someone has a house that's safe to live in or not. But that is the situation that we're in and that we're heading towards. So instead, as 350 Australia and as a climate justice grassroots organisation, we believe that those who are causing the crisis should be the ones who are paying the bill. And so that's fossil fuel companies. So coal, oil and gas companies, we know, are responsible for more than 75% of global greenhouse gas emissions. In Australia, they've been making record profits for the past few years. That includes more than $30 billion in 2022 alone. So we would propose that you could impose a levy on the import and production of coal, oil and gas, and that would provide much needed funds to cover the costs of climate disasters. And this kind of levy could be based on greenhouse gas emissions associated with the import and production of these fossil fuels. So there's lots of policy proposals around of what this could look like. An analysis by Professors Garneau and Sims has shown that Australia could raise over $100 billion a year by imposing such a levy, if the levy was to be set by the EU's carbon price. Sorry, that's 100 Australian billion a year. And this should contribute to paying for climate disaster recovery here in Australia and adaptation, including preparedness for at-risk communities. So not just disaster recovery, but also adaptation and preparedness. And it also should allow us to increase our contribution to global climate finance as well. There's a really urgent need for Australia to be raising more funds to prioritise adapting to climate change and loss and damage, and this would take the burden off individuals and communities. A 2019 assessment of 54 national adaptation plans ranked Australia as the second lowest performer. Climate Council modelling shows the annual cost of damage to properties from extreme weather and climate hazards could be $85 billion per year by 2030. Requiring fossil fuel companies to pay for the damage caused by their pollution would also enable us to do our fair share internationally. So the UNFCCC established a loss and damage fund in 2022, which is a really significant milestone, and this was operationalised last year. It has an initial goal of US $100 billion between 2020 and 2025, and significantly more will need to be raised beyond that. According to a coalition of aid and development organisations, Australia should be contributing to this loss and damage fund, and then on top of that, we should be aiming for about $4 billion per year in climate finance. At the moment, we're falling well short of that. A levy on tax on fossil fuel production and imports should be an interim measure alongside an end to approvals of new fossil fuel projects and a plan at the national level to phase out fossil fuels entirely with a just transition for workers. I'd also like to add that 350 Australia sees the need for a comprehensive national adaptation plan backed up by a lot more funding than there is at the moment. So 350 Australia works with people in the Torres Strait who have been calling for increased government funding for adaptation measures that are critical to their ability to live and practice their culture on their islands. There's an urgent need for the federal government to fund seawalls and very important adaptation measures. In 2022, the United Nations found that the Australian government is violating the human rights of Torres Strait Islanders by failing to implement proper adaptation measures. And I'll close there, and I've also sent through these points in a late submission that I'm seeking to be tabled by the committee.
Thank you, Ms. Mann. And just a question for the committee, if we all agree to table the submission?
Yeah, I'd like to receive it, but
Sorry,
do we have a copy of it?
It's been circulated.
It's been emailed,
I'd like to see
emailed
it
through.
first, yeah, I think.
Okay, we can decide after the
Yeah.
hearing. Yep. Thank you. And Senator Sheldon, could I open with you the questions?
Yep. Thanks for joining us this afternoon. And you mentioned the concept of having a tax on fossil fuel production. Just one question I've really got in that space. We've had some evidence in that space already during the hearings. Just if we're relying on fossil fuel taxes for mitigation work and for insurance questions of insurance products, at some point, and of course, regardless of that tax, we've got the horrific issue of climate change that's upon the community. So doesn't that mean that we're depending on production continuing to make sure that we keep having funding going towards that mitigation and that insurance pill? So what if you got a view beyond the fuel tax or the fossil fuel tax? Is there something at some point we would hope that is negated?
Yeah, absolutely. So I think that one point is, I think a levy on fossil fuel companies we'll propose would be not a replacement for insurance, but it would rather be something which would go to the federal government to be distributed. So it would be public money, that would be public revenue that would be raised, and that this would be an interim measure. And so this would be, while fossil fuel companies are doing damage, they should be paying for that damage, and we would actually propose that it should increase over time, so much like the way the EU carbon price is intended to increase, so that, you know, as we go on and we want to see these industries winding down in an orderly way, you actually would increase the costs on fossil fuel companies. And so you would have a situation where over the next several decades you would have increasing revenue which could be used for adaptation, and a lot of that funding is not just for disaster recovery, but it's also about adaptation resilience, which means hopefully your communities are more resilient from that funding. So you're doing projects that are part of long-term adaptation resilience work, but it wouldn't be an indefinite, by any means, it wouldn't be an indefinite source of funding, but it would be sufficient to raise a huge amount of money in kind of the medium term over the next couple of decades, and that would really significantly contribute to funds needed for adaptation, resilience work and disaster recovery as well.
Yeah, I was asking more of a question about at some point that reliance on that fund will decrease as we're using less fossil fuels. And there's a pool of funding coming through for ongoing need beyond the fossil fuel tax actually being available under your proposal. Have you got any longer term vision about where some other funding pools could come from to replace what that fossil fuel tax would be? I'm just curious.
Yeah, no, I think that would be a question at that point for, where that public funding could be raised. I think, if you look at the next to 2030 to 2040 to 2050, there's so much in that time frame that needs to be done in terms of urgent adaptation. I think it would then be a public policy question of, once these industry is winding down, what are the projections beyond that? And, there would be a range of options. The mining industry overall in Australia, not just fossil fuels, but overall, when you compare it to, say, a Norway or other jurisdictions, there is a lot less royalties and tax coming from the mining industry overall. So, potentially there are other opportunities around royalties and taxes there. But I think that's, an important medium, long-term conversation. But I don't think it means you shouldn't be raising money from those who are causing the crisis right now as they continue to make record profits.
Yeah. I'm just interested in this question of, the dilemma of, on one hand, of what's proposed is, whilst, we're considering what you're putting to us, is that if we were to immediately end coal and gas production, that would end that funding though, wouldn't it?
So I think you'd actually want to design it in a way that it contributes to the phase out of fossil fuel production. So you'd want to design it in a way that it would increase over time, and that would make it more challenging, for example, for a coal or gas company to expand and create a new project. And so you'd actually be contributing to the phase out. So you would be raising more money over time because you'd be increasing the cost on them, and that would contribute to a phase out, and that could be part of an overall plan for a fair phase out of the industry alongside just transition plan for workers and communities. And then, you would absolutely need a plan beyond that, an alternative plan at that point for raising revenue.
Back to you, Chair.
Thank you, Senator Sheldon. I might ask a few questions and then pass on. Just following on for Senator Sheldon's questions, kind of demanding that the fossil fuel industry or coal and gas close down is about actually addressing the heart of the issue that we're at. But closing it down in the next few years doesn't mean that you shouldn't collect enough kind of levy from those corporations who have caused that damage for that money to continue on for a few decades to help us adapt and become more resilient. Is that kind of where you're coming from as well?
Exactly. And also we need to ensure that polluters are paying for the damage they're causing, also because that's a price that isn't currently factored in for them. They're not having to pay for that damage currently, and they should be. And so that is something that should be contributing to their whether or not they're able to open up new projects. We need to be increasing the costs on them so that externalities like greenhouse gas emissions have to be taken into account by them as well.
Yeah, so it provides funding to go beyond, much beyond when these companies close down.
That's right.
And were you also suggesting, Ms. Mann, that polluter pays, using that polluter pays principle, the money that is kind of funded through fossil fuel corporations should be used for adaptation and resilience, should be used to repair the damage that is caused by climate-driven disasters, and also could be used to lower insurance costs as well?
So there's lots of different ways you could allocate the funding, and I think it would make sense to have a fund that would do all of those things. So it could include funding for adaptation and resilience work in Australia. It could include also payments for households. So it could have an equity part of it where, for example, low-income households, much like in some situations could have an energy subsidy. You could also have a part of it which would address the insurance issue more directly. And you could also include funding to ensure that we can meet our climate finance and loss and damage obligations internationally as well. And so depending on how you calculate it and the design of legislation, it could raise a really substantial amount of funding, and so you could design it to go to those different streams.
And we have obviously heard from witnesses throughout this inquiry how important, now that we have come to this stage in the climate crisis, adaptation and resilience has become. But also that adaptation and resilience, of course, has to be done, but it doesn't address the mitigation required to address the climate crisis. What, from your organization's perspective, what stronger action should this country be taking to address that?
So 350 Australia, we are particularly focused on the need to move beyond our fossil fuel exports. So I'm sure, as the committee is well aware, Australia is one of the largest exporters of coal and gas in the world, and it's very important, first of all, that we stop making the problem worse by opening up new projects. And so that means no approvals for any extensions or any new coal mines or gas fields. And this is consistent with the International Energy Agency and the IPCC, their modelling in terms of what's needed for even a reasonable chance of meeting our global goals of 1.5 degrees. So that's what the science says, and it's something that would be very possible for the federal government to do, particularly through reforming the EPBC Act, which is before the Parliament at the moment, and other measures. And so that would be a first step, is to end the approval of new and expanded fossil fuel projects. And then the next step is really to make a plan for a phase out and to make sure that that's done in a planned and orderly way with a transition for workers and communities. And so we know that by 2030, thermal coal, we should stop exporting thermal coal, and shortly after that, gas as well. So it's not about overnight, but it's about having a clear plan and being able to move towards that at a federal level in an orderly way.
What is the most, I guess, dire scenario that you can predict if things continue on as they are? And I'm talking about climate and insurance as well, because you've highlighted as well, and so many others have too, how the incredible increase in insurance premiums, which is far outpacing inflation increases, is affecting more and more households in terms of unavailability, unaffordability as well. So the nexus of the two, what do you see happening in the next 10, 20 years?
I think if Australia fails to drastically reduce our fossil fuel emissions and our fossil fuel exports, there's a real existential threat on the table for a lot of the communities that 350 Australia works with, whether that's the Northern Rivers or in the Torres Strait, where there's a real fear and a real risk that's existential around the ability to remain in the Torres Strait on islands and to continue to practice culture there. And beyond that, there's the equity issue of insurance is, of course, a consumer product that depends on the consumer's ability to pay. We know that those on lower incomes are often in more at-risk places in terms of climate disasters already. And then the impact of rising insurance premiums will have a disproportionate impact on those households again. And so by putting this on individuals as a commodity, I think a real widening of economic inequality as on top of the impacts of worsening climate disasters is a risk that really needs to be addressed. And I think the answer to that is public goods and public funding for those goods, which can be provided by governments. And then that raises the question of where the revenue comes from. And that's why we believe a polluter pays approach makes the most sense.
Thank you very much, Ms. Mann. Over to you, Senator Sharma or Senator McLaughlin.
Yes. You've referenced a couple of reports in your submission, I think the Garno and Sims and a variety of figures. I'm not sure whether you've footnoted those in your submission, but if you haven't, could you sort of provide the background material for those statements in your opening statement?
They're all footnoted.
Yeah, if they are in the submission, that's fine.
Yeah, they are.
I obviously haven't had the advantage of reading it. Just on the polluter pays principle, I understand your position in relation to fossil fuel companies, but there's also the demand side. So there's the people that take the fossil fuel and they also then turn it into a form of pollution. So do you have a view on whether they should be levied? Because there's supply and demand, and it's those that demand the fossil fuel that are also creating subsequent pollution. Why have you settled just on the fossil fuel companies and not on the producers? For example, an aluminium smelter or something like that.
Yeah, so the fossil fuel producers are, making the decision to export and produce and to profit from that and are having record profits. And I think that there's a real gap in the way that we look at climate change internationally and in Australia in terms of only focusing on the demand side. So there are various policies in place around the demand side already. There's a safeguard mechanism. As 350 Australia, we'd love that to be stronger, absolutely. But at the moment, there's really nothing to address the production side, and that is a really huge and clear gap. And so it's just something that needs to be addressed. It can be addressed in various ways, and one of the ways to start to do that is to build in the cost of the damage that's caused by this pollution. And so at the moment, it's just not being addressed at all. It's a huge policy gap.
I understand your position on that. I'm just interested whether you see further levies on or other initiatives in relation to the demand side, to the actual polluter.
Also, one relevant point to that is in the modelling done by Professors Garneau and Sims, that includes a levy also on imports as well, fossil fuel imports. So that starts to address that to some extent. I also could follow up with more information. I don't know all the details off the top of my head, but there's also various mechanisms you can use to look at, thinking about where it's going and whether it's priced in at the point of sale, that kind of thing as well, can all be thought about in the policy design.
Yeah, that's where my question was going, just to see where you're seeing, from your perspective, the best intervention. You put you mentioned an orderly phase out. I mean, does your organisation have a view on how long that phase out should be? I mean, why doesn't your organisation say, for example, fossil fuel exports should stop now?
So we look at we draw on the International Energy Agency, and we also draw on the IPCC and the modelling, and often that's at a global level. So then we would look at, okay, Australia as a high income country, what can we do and what's our responsibility? And it's pretty clear for thermal coal in particular that a phase out by 2030 is what's needed. And so we would say for our thermal coal exports and production, that should be by 2030, so 5.5 years from now. And then for gas, based on those estimates, the best number we have is 2034 for LNG as well. And so that's the reason that we're not saying it should all happen right now, is because we do want there to be a transition for communities and for workers, and also for the energy systems within Australia. And we know that based on the best modelling that we have, that's what the science requires, and it's also achievable. But the most important thing that we can do right now is just not approve any more extensions or expansions to the existing facilities, as well as new projects.
No, thank you. No further questions.
I had a couple of
Yes, yeah, please go.
Can I just ask, is 350.org, is it 350.org or just 350? I don't know.
Either or.
Okay.
Yep.
Have you still got your DGR status? I gather that was being investigated some time ago.
That wasn't investigated. Our ACNC status, we had some back and forth before my time, and nothing came of it under the previous government. And we are a proud registered ACNC charity, and we also recently have received DGR from the ATO as well.
Okay. And what was the protest or blockade of the Port of Newcastle that 350 was involved in 2017, I think? What was the purpose of that protest?
I couldn't speak to that because I wasn't the CEO of 350 Australia at that time.
But I understand it was like calling for the immediate cessation of coal, fossil fuel and gas exports at that time. But so I'm just trying to understand, is your position it should be ended by 2030, I think you said to my colleague, Senator McLaughlin, or has that position changed? Because I think in 2017, from what I understand, the purpose of the protest was to call for the immediate cessation of these exports.
Yeah, I guess I can't speak to previous protests. What I can say is what our position is and has been for as long as I'm aware of at 350 Australia, which is about a fair and fast phase out.
Okay. Were you at 350 in 2017 when these protests?
No, I wasn't.
Okay. All right, nothing further from me, Chair. Thank you.
And Senator Sheldon? Thank you very much, Ms. Mann, for coming here and giving us evidence.
Great, thank you very much.
That concludes the committee's hearings for today. I thank all witnesses who have given evidence to the committee today. Where witnesses have taken questions on notice, the committee requests that information be provided within 2 weeks by Monday, 14th October 2024. However, please liaise with the Secretariat if additional time is required. Thank you to Hansard and Broadcasting and the committee Secretariat. The committee stands adjourned.